the everything rally is likely to continue for a little bit longer.
I think stocks can continue probably to do well, high-quality stocks, though.
The winners themselves, when momentum is high, can continue to do well.
There's still very much a speculative fervor within the market.
We've been bullish. We remain bullish. We still, very much seem to be in this sweet spot.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Let's get you to the weekend. Live from New York City this morning. Good morning for our audience worldwide. This is Bloomberg Surveillance. AMH back in a hot seat. It's been a while. She can tell us where she's been in just a moment. Equity futures on the S&P 500 positive by 0.1%. Four-day winning streak on the S&P 500. 20th all-time high of 2024. The data's pretty decent. Central banks are leaning into rate cuts. What's not to like?
Which is the reason why everyone seems incredibly risk-on, which maybe should make some people worried, but it doesn't, because there's no reason not to. You've got the fiscal impulse on one side, you've got the monetary impulse on the other, and they're both going in the same direction, which is things going up.
Bit of Fed speak a little bit later as well. I think Chairman Powell opening a Fed Listens event. We'll hear from Bostic and Barr. What are you looking for?
You want to know the truth? I looked at this, and he's going to come out and say, I'm so glad, I'm ready to hear and listen. I don't think he's going to try to say anything, but the interesting thing is he's not going to try to say anything. No one's talking about cleanup on aisle 2, Jay Powell.
True.
Which to me is telling, because after December, people said, okay, well, who's going to come out and say this was a bit premature? Now it's clear. It's a dovish pivot that was real back in December, regardless of the data.
We are listening to the DOJ just yesterday. Check out shares of Apple, down yesterday by about 4%, this morning higher by 0.2% in the pre-market. The DOJ suing Apple for violating antitrust rules. Annmarie, welcome back. We need to get into that. What stood out for you in that report?
Well, there's a number of things they're alleging in terms of these antitrust. It feels like what they say is that rivals are not able to access the hardware or software that Apple keeps so closely guarded. For me, though, it had to be they take issue with the fact that if you're an iPhone user and you mess at an Android user, it's the green bubble versus the blue bubble. And if you read the more than 80 pages of this lawsuit, they actually say social stigma was part of it. So there's a lot of individuals who are pushing back on this and saying, is this going too far in terms of really calling out Apple for a monopoly?
What I found interesting was that previous antitrust suits didn't have a market reaction. All of the sort of legal action in Europe didn't seem to matter to Apple shares. Suddenly, this one matters a whole lot. Is it because of the substance of the suit or because it's just convenient timing and people are souring on Apple after a pretty substantial decline in the face of weakness?
Can I say both? Because the list is long. China, increasing competition.
Exactly.
Take your pick, Bramo. We're down about 11%, I think. Double-digit losses so far year-to-date on this stock.
Which raises questions. Is it just sort of the final nail in the coffin for Apple not being part of the Magnificent Seven?
You know what was impressive about yesterday, though? Alphabet down year-to-date, having a difficult year. We've got Apple down year-to-date by double digits. Throw in another surprise this week. We've priced out rate cuts again over the last year, OK? You've got Apple down double digits, which used to be the market darling of the stock market, the poster child for US tech, and yet still the S&P 500 is up by close to 10% year to date. Now, we've talked a lot about things we'd be surprised about in January, sitting here saying, OK, if I told you Apple was going to be down double digits in 2024 by the end of Q1, that we'd price out half the rate cuts we had priced, and then said to you the S&P 500 would be up close to 10%.
What is interesting is this goes to sort of the broadening out and also this question of where are we in this credit cycle? Where are we in this economic cycle? People were saying late cycle last year. Now suddenly Max Kettner of HSBC saying maybe it's sort of early cycle behavior, given the fact that you're seeing, maybe potential signs of weakness. But where? Quits rate? Is that really as good as you can do?
That was quite a change from Max Kettner over at HSBC. I read that story this morning. This is not a bubble. This was his note. We're overweight high-yield credit and equities. Overweight oil as a play on the global economy picking up. The attitude, the sentiment shift has been phenomenal in the last few weeks.
And it is global. And you're seeing that in flows. People diversifying outside of the U.S. They want to sort of capitalize on a global growth wave, even though people previously said it was from the U.S. and U.S. exceptionalism. Now it's U.S. is crowded and let's move out and try to really just explore this new early cycle behavior. Are we really early cycle because banks are doing maintenance cuts? Central banks are doing maintenance cuts? I don't know the answer to that, but I think that's one kind of new theme that's developing.
I do know that this week is fat exhausted exhausting, so let's get straight to it. Equity futures on the S&P 500 positive by 0.1%. Here's the state of play. Yields a little bit lower. Again, we're down 3 basis points on a 10-year, 423.75. Coming up this hour, we'll catch up with Bob Michael at JP Morgan on the Fed's path forward, Bloomberg's Alex Webb on Apple becoming the latest target of Washington, and Peter Oppenheimer of Goldman Sachs with US stocks cruising to all-time highs. We begin with our top story. US stocks posting another record, heading towards the biggest week of gains so far this year. Bob Michael of JP Morgan Asset Management writes in this: the soft landing continues to unfold everywhere, with the tail risk of re-acceleration or contraction looking equally balanced. What's the biggest risk? Fed policy error. Either they cut rates too soon or too late. Bob joins us now for more. Bob, good morning.
Good morning.
Can you pick one for us? What is the biggest risk out of those two options?
That the soft landing continues to unfold for the next 18 months, and people are still stuck in cash. And every meeting I have, and I've said this for the last several months I've been here, that's the first question I get. I have too much cash. What do I do with it? Where do I go? Everything's gone up in price. What am I going to do? And I sit there and I wonder, how could everyone have more cash yet every asset price has gone up? Where the hell is it all coming from?
Truly the everything rally. We've seen it in bonds, we've seen it in stocks, we've seen it in commodities, you've seen it in gold. Can I ask you the question you've asked yourself? Where is it coming from?
I don't know, but I've lived through this before, and it was 1995. We had our investment quarterly yesterday. We talked about it. At the end of 94, it looked as though we were barreling into recession. The Fed had doubled the Fed funds rate. U.S. Steel had defaulted. You had the tequila crisis. Orange County defaulted. Everyone was 100% certain we were going into recession, and everyone was risk off. And then we had that immaculate soft landing. The Fed took the edge off of things. They cut rates from something like 6% to 5.25%. And the markets did fantastically well. And we were talking about, well, surely going into that, credit spreads must have widened a lot. And Lisa Coleman, who runs credit for us, looked at me and said, you ask me this question every 3 months. No, in 94, they were dead flat. They didn't move a single basis point. And we're seeing the same thing. The demons are at work. People are worried about a reacceleration, or we eventually will roll into recession. They're waiting for a better buying opportunity, yet credit spreads are holding in, and there's just still too much cash out there.
Which raises this question: have you shifted your stance a little bit on the margins? You used to say that the biggest risk was really a recession. That was your call. Is this a new call for you? The idea that it's equally balanced now with a reacceleration and potentially a real inflation problem?
Thank you for reminding me that a year ago, we were all so certain that we were headed into recession.
Anytime. I'm here for you, Bob.
After all, the regional banking system did blow up, and it looked as though, and the Fed still went ahead and hiked rates 100 basis points in the first part of last year, and for sure it looked like recession. But in September, we threw that away and went to more the soft landing camp. So we've done reasonably well. I sit here and we try to find, where is the smoking gun? Where are the demons? Where is there legitimate proof that actually there's a frailty that will become manifest in the downside? And it's too hard to find. And actually, there are more signs going the other way. When we talk to the credit research teams, whether it's investment grade or high yield, they're telling their companies just look better, that EBITDA is starting to go up again, that actually companies are more confident about their cash flow and their earnings. So it actually feels that there's more of a stabilization than downside.
When you talk about where is the money coming from, I'm struck by all of my conversations this week and over the past couple of weeks about how much fiscal money has been pumped into the system and how people who received it and companies that received it aren't going to go out and spend it in some of the line items. They're going to invest in stock market, which is part of the reason why, and the bond market, which is part of the reason why there's this wall of money just flooding in. Is there a concern on the government bond side that there's going to be some sort of coming home to roost with respect to the leverage being transferred from the private sector to the public sector?
I don't think so. And we also looked at the amount of money in plans like ARPA that have yet to be distributed. There's still 44% of the $1 trillion that have been set aside that have yet to go out into the economy. So that's already a sunk cost, so to speak. And you're right, the policy stimulus was literally off the charts. You had to go back, when you look at the combination of fiscal and monetary, to World War II to have any kind of relative metric. But we had a pandemic. It's what we needed. It got us through it. And now we're coming out the other side. It will take time to work down, but it doesn't seem to be a problem. We can't be concerned about the amount of Treasury supply out there when the entire Treasury curve is trading over 100 basis points through the Fed funds rate, except for the very front end, the 2-year. So there's still plenty of demand out there. There is no alternate reserve currency in the world other than the dollar. So there will always be Bitcoin. Let's not go there this morning. It's too early for me to go there. That there will be support for the dollar, and the quickest, easiest way for a large official institution to maintain dollar reserves is to buy treasuries. We're not worried.
But to Lisa's point, do you think down the road you'll ever have this concern of the path we're on in terms of the U.S. deficit?
We are in a world of modern monetary theory where when there's a crisis, even, the pandemic was a big one. The regional banking crisis, people want to say it wasn't a crisis, but only because the policy response was overwhelming. Governments borrow, and the central banks help to underwrite that. But it doesn't just disappear into the ether, right? The amount of fiscal stimulus you get actually goes into the system somewhere. There is a credit multiplier, a credit extension effect to it, and that's helped to boost the economy. And we saw that early this year when the Treasury dialed back the expectation on the amount of issuance because guess what? Tax receipts were up, which is exactly what you want when you apply that amount of stimulus.
So let's put together some of the things you've told us so far. So the economy's pretty decent. Biggest risk is upside risk and maybe the extension of this cycle for another 18 months. You mentioned the inversion of the yield curve as well. So we've got a 2-year at the moment about 460, a 10-year at 424. Given everything you've told us, how are you convincing clients to go further out along the curve to pick up less yield? What are you telling them?
Yeah, that's a really good question because the Fed funds rate has to come down to 4% to legitimize the Treasury curve where it is. And for sure, if it comes down to 4%, the front end, the 2-year drops from 460 down to about 4%. But 5s, 10s, 30s stay about where they are. It's not so much that. It's looking out into the market, looking into the investment grade credit market where you could pick up another close to 1% going into the high yield market, the securitized credit market. That's where you're starting to pick up yields that are in that 5.5 and higher in high yield, close to 8% range. And those are the kind of yields and credit spreads that will come down once the Fed starts its rate cutting cycle.
You mentioned there was so much cash coming in. Where is the cash going? Where are you directing it at the moment? What are the biggest things you're advocating for?
Well, we do like credit. Just because corporate America looks so good. And I myself have gone full circle on private credit. It's so big, I accept it as a legitimate source of non-bank lending into the system.
Okay, this is a change. What's changed your mind?
Well, one, the fact that it's larger in size than the public high yield market, so that's pretty significant. That it is getting out there, it is lending to borrowers. Those borrowers aren't just sitting on it, they're actually hiring people, they're using resources, they're creating economic activity. Even if you think, put some unimaginable default rate out there, 20%, that still means 80% is money good. And while there are problems that are ongoing right now, whether you want to call it an amend and extend or exchanges or restructurings, they're occurring, and they're happening without all the fanfare if they happen in the public market. So it's a strange form of reinsurance to the public credit market. So it's another reason we like the public credit markets because they just look so clean right now.
I love it. It's like
okay, shoot me to ribbons.
No,
go ahead.
It's like a self-help
It's okay.
group. Good morning. My name is Bob, and I am accepting private credit.
I love how everyone knows that Lisa's just sitting there coming up with the biggest comeback for anyone who's bullish. Bob,
I think it's great.
Can we finish by asking you a simple one, Bob? When was the last time you were this bullish on your asset class? When was the last time? You mentioned the mid-90s. When was the last time you were this bullish?
Oh, gosh. You have to go back to the mid-2000s.
Wow. Does that make you comfortable or uncomfortable?
As long as it's not 2007.
I feel great because I feel post-financial crisis, we've sort of been in a la-la land where there's been a lot of policy intervention along the way because it was needed to recover from what happened during the financial crisis. And hey, blame us, the baby boomers. We learned about leverage and housing never went down in price, and we figured out how to blow it all up. And it took over a decade to put Humpty Dumpty back together again. And we see that's what's happening. We see that the 91 births are the largest population cohort. They're turning 33 this year. They're the dominant earner, spender, saver. I think we can toss away the last 15 or so years and look at the period pre-financial crisis when there will be a demand for capital, there will be a cost to it, and there will be a productive use to it. So I'm very optimistic.
This was thoughtful stuff, Bob. It's great to catch up with you, to kick off this Friday morning and start to close out this week. Bob Michael of JP Morgan, thank you, sir. Let's get you an update on stories elsewhere this morning. We can do that with your Bloomberg Brief. Here is Yahara Hackers. Hey, Yahara.
Hi, John. Investors took a $113 billion bite out of Apple's market value following regulator moves against the company. The DOJ and 16 attorneys general filing a lawsuit accusing the iPhone maker of blocking rivals from accessing hardware and software features on the iPhone, a claim Apple strongly refuted. Across the Atlantic, the company is also set to be facing probes about whether it's complying with Europe's Digital Markets Act. Tesla has reduced electric car production in China amid sluggish sales and intense competition in the world's largest auto market. Sources telling Bloomberg the company instructed employees at its Shanghai factory to lower production of both the Model Y sport utility and Model 3 sedan by working 5 days a week instead of the usual 6.5. Nike warning investors sales will take a hit later this year, pushing shares lower in extended trading. The world's largest sportswear company says it's working to realign merchandise to better match what shoppers actually want to buy. Nike says revenue and earnings growing next fiscal year as it expects to see a payoff from a $2 billion cost-cutting plan announced back in December. That's your Bloomberg Brief. John?
Yahara, thank you. Up next on this program, the DOJ looking to rein in Apple.
We allege that Apple has employed a strategy that relies on exclusionary, anti-competitive conduct that hurts both consumers and developers.
We'll see how difficult that is to prove. That conversation up next. Lisa on the edge of turning bullish. I don't know how that makes you feel.
No, hold on.
Maybe just sit on that.
Hold on.
You're just waking up this morning. You're thinking, what should I worry about? Data's decent, Fed's about to cut interest rates, stocks are at record highs, everything's rallying. Lisa is on the edge of turning bullish.
Hold on. I understand why this could continue. What worries me is that the wall of money is going into specific areas that when the tide rolls out, they will crash. I can come up with the bears.
That's a worry. Okay.
Yes. It's just hard to see it imminently.
On the edge of bullish.
You get
this close.
Stimulus from every side, so you'd have to
closest she's ever been. Well, never been this close to being bullish. Equities right now positive.
It's almost the weekend.
By 0.1% on the S&P 500. Under surveillance this morning, the DOJ looking to rein in Apple.
We allege that Apple has employed a strategy that relies on exclusionary, anti-competitive conduct that hurts both consumers and developers. For consumers, that has meant fewer choices, higher prices and fees, lower quality smartphones, apps, and accessories, and less innovation from Apple and its competitors.
Here's the latest this morning. The US Department of Justice suing Apple, accusing the iPhone maker of violating antitrust laws by blocking rivals from accessing hardware and software features. Apple shares sliding 4.1% yesterday, wiping out nearly $113 billion in market value. Bloomberg's Alex Webb joins us now for more. Alex, can we start with the victims? Talk to me about this. Who are the alleged victims of these violations?
So it's not necessarily other smartphone making companies, but it could be a lot of people offering services on Apple's platform. So we've heard complaints, for example, from Spotify about the way that actually not only payments are taken, right, that they have to pay a certain cut to Apple if someone signs up for Spotify on the device, but also Apple would not let them tell their customers on the iPhone that if you went and subscribed online, then you didn't have to pay that cut and it was cheaper. There are companies such as the people who want to make mobile payments possible, as in contactless payments. So at the moment, you can only use Apple Pay with an iPhone. One of the things that the DOJ is saying is that actually other services, perhaps even like Android Pay, should be available. So it's a lot of smaller companies offering, I mean, Google is a smaller company, but not that much smaller, who are trying to offer products and services through the iPhone platform, who the DOJ alleges have been squeezed out.
I don't know, Alex, who's waking up this morning, though, and shedding a tear for, say, a credit card company like Visa or a bank that says that they can't have a digital player when it comes to the Apple Wallet. But what is the DOJ remedy? Are they actually going to call for a breakup?
Well, you know, you often talk about behavioral remedies, right? So they'll be forced to actually change some of the setup that they have in the device. We've seen that already in Europe in many different ways, in terms of the menus you have for what is the default, for instance, search engine when you open a smartphone. What is the default then payment service that you would use? These are the sort of behavioral remedies that might be possible. There are other things, of course, you know, other companies, from smart watch makers, for instance, who don't have the same sort of smooth operation with an iPhone as does the Apple Watch. You have to, they could be then forced to open some of those APIs to make it easier for competing devices to have their data, for instance, appear in the Apple Health app.
What have we learned from other such suits facing Apple about the fact that Apple says they need to do this for security reasons?
So Apple often makes this argument, right, that this is about the quality of their service, of the quality of the Apple experience, that if you let a bunch of other sort of unmediated, unchecked apps and services onto the device, then it will be deleterious to the customer experience, but also could affect security. The counterpoint to that argument is that ultimately that's a choice for the consumer to make themselves. If it is true that Apple's service or product lineup is that much better, and that gets worse if you let other products and services onto the iPhone without Apple standing as a sort of gatekeeper in between, well, then that's something that the market should be able to decide itself. So, you know, there is a strong counter-argument to Apple's assertion.
Alex, in a lot of cases that we've heard over the EU going against Apple, shares haven't sold off that much. A lot of people shrugged it off as just sort of window dressing, regulatory theater. Why is this different?
This is probably the broadest kind of full frontal assault that we've seen on the Apple ecosystem, all in one go. We've seen a few sort of, you know, chips taken off Apple and, of course, other big tech companies by the European Union in previous years. The fact that this is obviously happening in Apple's home market is meaningful. Now, whether or not this leads to widespread changes at Apple, you know, this is a long way to go in this, a long way to run. Even if the DOJ were to come out with some sort of victory, the changes aren't necessarily about what changes on the device or changes on the operating system. The fear is that it has an effect on the Apple culture. This is something we saw at Microsoft, that when they were subject to years and years of antitrust investigations and complaints, they became a little bit warier about taking risks. And that is something that ultimately was deemed to have hurt them and made them less competitive in the medium to long term. Obviously, in the extreme long term, they're now the most valuable company in the world again. But there was a good 10, 15-year period where they were in something of a wilderness. That is the concern of the sort of massive effect that could have on Apple.
There's so many different dimensions to this story. Alex Webb, thank you, sir, of Bloomberg out of London. On messaging, great Wall Street Journal op-ed piece that you sent over. Is it federal law to require tech to be interoperable? That's not clear at all. It's not.
It's not clear. So what they need to do is show that this is a proper monopoly, which potentially is going to be very difficult. And we've seen Apple uphold what they do based on security reasons before in court. So this is going to take years.
That stock slightly positive in the pre-market. Coming up, Helene Becker of TD Cowen from New York City. This is Bloomberg. Four-day winning streak on the S&P 500. Equities doing okay, positive by 0.1% on the S&P. On the Nasdaq, up by 0.1. Yesterday, losses on Apple down by more than 4%. Losses of more than $100 billion on its very large market cap, and yet still this Nasdaq 100 closed at record highs. In the bond market, 2-year, 10-year, 30-year, quite a repricing at the front end of the curve through the week. We've been all over the place. 450s, 470s, 461 this morning. Lisa, we're down about 2 or 3 basis points.
And why not? I mean, honestly, they're just following the direction from the Fed that basically said they're not that concerned about inflation data that came in hotter than expected. They're on the right path, and they plan to cut. Now we have a pretty good sense in the markets that they are going to cut in June. So it's off to the races. You've got federal funding, you've got monetary policy, both on the same page, and let's go.
You know what's had a really good week? And you asked the question earlier this week, and we're going to talk to some guests about it. What's good for banks? Higher rates or lower rates? Banks have had a great week, really stealthy run. 5 days of gains, I think, up 4.7% this week. Best week since December if we close here.
And I know we're going to talk more about some of the capital markets activity, but how much of this is because the green light that we've seen from monetary policymakers, but also from the federal government, has allowed new types of deal making, new types of activity, money just pouring into the system, and banks are going to capitalize on that at a time where delinquencies are not picking up the way that some people had expected them to at this point in the cycle.
Let's finish on foreign exchange. Something that has picked up over the week is the US dollar, believe it or not. Euro dollar's down to 108.18. We're negative by 0.4% this morning, so some more dollar strength. We're leaning into cuts from elsewhere. Cuts out of Switzerland, hikes that don't work in Japan, and potentially cuts in the UK in the not too far distant future too.
The US economy keeps outperforming. There are no signs. Bob Michael just said he's hearing from different executives of small companies. They're picking up. Every single analyst says that they're going in the opposite direction. So at a certain point, why wouldn't people still like the U.S. as much as they don't want to? And you talk to people, we want to diversify. And then it doesn't work. So we just hear this again and again. So that's why people keep coming back to the
Literally everything with a dollar in front of it has rallied this week. That's what it feels like. Equities, bonds, in foreign exchange, the US dollar. It's been kind of wild. Under surveillance this morning, the Justice Department taking aim at Apple, accusing the tech giant of violating antitrust laws, wiping out $113 billion in market value. 15 states, plus Washington, D.C., joining the complaint, saying the iPhone maker blocks rivals from accessing hardware and software features on its most popular devices. Apple responding to the lawsuit, saying the case is wrong on the facts, wrong on the law. The news comes as the EU is also preparing new investigations into Apple and Google for alleged violations of rules aimed at big tech. And Lisa, you're right to point out, typically, this isn't a stock story. It's just part of the environment that surrounds the likes of names like Apple, Google, and others too. Yesterday felt different.
And I can't really wrap my head around whether it's because this suit is different in its nature, as Alex Webb was saying, it's broader and sort of challenges the fundamental aspects of Apple, or whether it's just sort of another thing on top of all the other challenges that this company has. To me, it does feel different, though. And the fact that the market responded was unusual, given some of the previous track records.
It's been a downpour when it comes to Apple in general. And John, your point to China, you have Tim Cook actually in China right now trying to shore up this market that's incredibly important for Apple. But Dan Ives at Wedbush had this to say: the antitrust lawsuit will, quote, kick off a stepped-up phase of the Beltway going after Apple. So is this more in the tank when it comes to the antitrust regulators that are looking at Apple, and potentially are we going to see more of this?
I don't want to reduce it to one thing, but the messaging thing I just don't understand. I don't understand it, and I'd love to hear from someone that does understand it. It doesn't make sense to me at all.
You'll be ostracized from your group chat. They're talking about actual social stigma. The issue I also take with this is that, maybe it's because I lived in Europe for a lot of years, most people are in group chats on WhatsApp, on Signal, on
Precisely.
Telegram. You don't need to be on an iPhone-only iMessage group chat. I'm actually only on one.
You're not locked in. You can use other options on the iPhone. I don't get it at all. And you mentioned the social stigma. The social stigma. Is that something the DOJ needs to be focused on now, the social stigma of messaging?
Of whether or not it shows up green or blue on your phone. It is an important
That's
thing that the
ridiculous.
Congress should be taking up right now.
Are we going to tell Gucci they can't put the label on the handbag anymore just in case that someone doesn't have a Gucci
right, and feels guilty.
emblem on and the social stigma of God? That's just ridiculous.
Yeah, I think that they should look into it. I mean, it seems like these are the important things that they should be
I'm
looking at.
serious, though. This is where we begin. Where does it end?
You know, you're correct to say this. And it's sort of how much are they grasping at straws to try to democratize something that grew up out of a lot of smaller acquisitions over years? Can you backpedal in time and undo that at a time where this is really a pretty aggressively antitrust administration?
The complaint includes a quote from Tim Cook at a 2020 Code conference, and someone raised their hand and said, I can't send my mom certain videos. And then Tim Cook said, buy your mom an iPhone. And that's included in this lawsuit.
OK, let's move on to a stock that is doing all right, better than all right just yesterday. Social media platform Reddit surging on its first day of trading. Shares climbing 48% and ending the day with a market value of $8 billion. Reddit's most loyal users were able to buy 8% of the shares at the IPO price of $34. The social media company also touting the benefits of artificial intelligence while kicking off the fourth quarter IPO, fourth largest IPO of the year so far. I'm not sure what the AI piece of all of this is, Bramo, but if you saw that move yesterday, a move of almost 50%, I'd be wondering if I'm just about to come public myself, how encouraged I'd be by the move we saw.
That was my big takeaway. Basically, this is a green light to everybody who wants to close out of investments, if you think of private equity or if you're thinking about going public. And that's one reason why I would suspect banks are kind of salivating and jumping at the bit, because this means a lot more deal activity. I will just say it does remind me of Overstock coming out and mentioning blockchain, and all of a sudden their shares, a furniture maker, the shares surged, right? I mean, how much is it sort of similar? You know, this company comes out, says artificial intelligence, and boom, to the races.
And that's the time we're in at the moment. Let's turn to FedEx, rallying after announcing a $5 billion stock buyback plan. The company's earnings also are beating estimates, and it offered an optimistic outlook despite a difficult demand environment. The results mark a turnaround in its Express division after cutting costs and reducing the company's workforce by nearly 22,000. Helene Becker of TD Cowen joins us now for more. Helene, wonderful to hear from you as always. Let's start with FedEx. The outlook for revenue growth is still not great. Can you talk to us about just how much of the heavy lifting of this company is being done now by cost cuts?
Yeah, that's most of what we're seeing here. The revenue lines were down year over year, and I think that's the key takeaway, that revenue was down, and it's the third quarter in a row where revenue is down and low single digits, and yet the earnings were up. And I think that speaks to the cost cutting that we're seeing. They're in the middle of a $4 billion cost-cutting program by the end of the current fiscal year, May of 24. They'll have done $1.8 billion, and then they'll do another $2.2 billion next year, so that the 2026 fiscal year, they've got $4 billion taken out of costs. And if there's a turnaround in revenue growth, and actually we can talk about the revenue, a lot of what you see in revenue is fuel surcharges. So in a year or a quarter in which you have lower fuel prices, you're going to have headwinds on revenue, and which is part of why it's important to look at revenue excluding fuel surcharges, which actually would have been up.
So there are two things here. Number one is, what are the prospects of growth? Why are people so excited if this is just cost cutting that cannot be continued in perpetuity? I would start there. Why are people so optimistic that this is going to be a more valuable company even after shrinking?
Yeah, so some of what you have here is short covering. There are a lot of people that were short going into the quarter. If you look back over, I don't know, I've covered the company for 30 or more years, and it seems like most quarters the stock does go down on the earnings release. We've just had a couple where the stock's actually gone up. But to the specific question, I think at some point, you know, revenue starts to bounce along a bottom, and then you start to see improvement. You're not going to have this poor revenue environment forever, right? Things do turn around, and you start to get into easier comps as the year goes on, and then they should start to improve. But yes, they're going to be a slightly smaller company. I mean, we're still forecasting that, 2030, 2032, they do $100 billion in revenue, up from around 91 billion now. But yeah, I think the focus in the short term is cost cutting rather. It's one FedEx, getting rid of all the different operating companies, and just focusing on continuing to deliver a high quality product to their customers, to their shippers, so that they can do 3 to 5 or 6% rate increases every year.
Elaine, a lot of people look at FedEx, UPS, although they have their own challenges right now, as bellwethers of this economy, and that typically when the revenues go down, it is a negative sign for consumer spending. Right now, everyone's coming on trying to outbull the other in terms of economic growth and in terms of investing in pretty much everything under the sun. Is this a sign of caution that revenues actually came in lower at FedEx?
Yeah, I think, well, some of it is the fuel surcharge. So, excluding that, you probably had flattish kind of revenues. But yes, they did say that the U.S. was weaker than they expected and that international was not improving significantly and that there were concerns. So I think when people look at the consumer, a lot of what they see is consumer spend, retail spend, or spending for airlines, as we talked about a couple of weeks ago when I saw you guys. And then you think about as people return to their offices, I think three things to focus on. One, as people return, B2B will start to improve. Two, I think we talked a little bit about pricing, so you have that. And then finally, things will start to wear out. Stuff that people bought in 2020 and 2021 will start to have to be replaced at some point. So that will start to show improvement, maybe in another year or so. But yeah, they were really optimistic. They were really upbeat and very excited about a lot of the changes that are happening there. And I think when you think about them being smaller, think about the Express division being smaller and think about Ground being bigger.
When you look at FedEx potentially, Wall Street Journal is reporting a stronger partnership with Amazon. Do you see that coming to fruition?
So that's interesting because, of course, FedEx fired Amazon as a client about 5 or 7 years ago. And now they're talking about getting involved with Amazon really for returns. Returns is big business. And I think Amazon makes it very easy to do returns, right? You can drop things off at various locations. You don't even have to package it up. And FedEx is building that business. And so re-engaging with Amazon for returns may make some sense. When FedEx fired Amazon, they were $1 billion revenue contributor. Versus UPS, it's about $11 billion in revenue. So it was relatively easy for FedEx to replace that revenue, and then re-engaging with Amazon for returns is obviously an opportunity.
Helene, thank you. We've got to leave it there. Helene Becker there of TD Cowen on the latest with FedEx. Can we get the stock up quickly? Just have a look at where we're trading in the pre-market right now. I could do that on the Bloomberg. If you can't get that on the screen, I'll do that on the Bloomberg, shall I?
12.5%.
Have a quick look. Is that where we are?
Yeah.
Big move, eh?
Yeah.
Quite a move. Amazing.
Which is sort of raising this question, how come there's so much ambition when it comes to this idea of future growth when all of the positive energy really is coming from pretty significant cost cutting?
Let's get you an update on stories elsewhere. That stock is up by 12.5%. Here's your Bloomberg Brief with Yahara Hackers. Hey, Yahara.
Hi, John. Ending the fentanyl crisis is shaping up to be a high priority for voters ahead of the U.S. election. A recent Bloomberg News Morning Consult poll sees about 8 in 10 swing state voters ranking the problem as an important factor in deciding their vote. That's more than the number who cite abortion, climate change, labor, or the current wars. Fentanyl has been linked to more than 250,000 deaths since the start of the pandemic. Aston Martin is tapping Bentley CEO Adrian Hallmark to lead the luxury car maker. Hallmark will take over from outgoing CEO Amedeo Felisa, joining no later than October 1st. Hallmark will be Aston Martin's 4th CEO in 4 years. The announcement comes after the UK carmaker completed a $1.4 billion refinancing earlier in the month in an effort to ease concerns over the balance sheet. Shares of Lululemon are lower in the pre-market after the athletic maker forecasts a lower than expected sales outlook for the first quarter and the full year. The company says visits to stores in the U.S. slowed at the beginning of the year. Lululemon has had a stellar post-pandemic run and continues to post robust results, with analysts still predicting the company will outperform its conservative guidance. That's your Bloomberg Brief. John?
Yahara, thank you. Up next on this program, the U.S. versus the rest of the world.
Expectations around growth and the performance of equities is expanding outside of technology and outside of the U.S. and into the rest of the world. So yes, it's this broadening out of growth.
We'll catch up with Goldman Sachs up next. Goldman Sachs looking to diversify. Equities on the S&P 500 positive here by 0.15%. Yields a little bit lower by 2 or 3 basis points. We're down to 424.14 on a 10-year. Under surveillance this morning, the US versus the rest of the world.
Expectations around growth and the performance of equities is expanding outside of technology and outside of the U.S. and into the rest of the world. The U.S. does well, too. Japan does well. Asia does well. The U.S. just does a little less well than all of the other areas. So, yes, it's this broadening out of growth.
Here's the latest this morning. Market dominance in the S&P 500 leading some investors to look elsewhere. Peter Oppenheimer at Goldman Sachs writing this. We believe that there are many companies outside of the US that should be considered as part of a global diversified portfolio and should not be ignored simply because their base and listing location is outside of the United States. Peter Oppenheimer joins us now for more. Pete, let's get straight into this because it's a really important theme. If it's winning, even if it's dominant, should I be concerned?
Well, the short answer, John, is no. I mean, the outperformance that we've seen of the US, which has really been particularly dramatic since the financial crisis, has been entirely based on solid fundamentals. The US economy, but most importantly, profits have simply outgrown those of other regions. But as a result of that, its valuation has risen a lot compared to other parts of the world. And now we're finally seeing a bit of a narrowing in the relative fundamentals. Actually, profits are picking up outside of the US, where the valuations are lower. And we think that the US market can still do pretty well, but there's some great opportunities outside, and diversification makes a lot of sense. And that's true at the sector and the stock level too.
Pete, we can talk about those opportunities in just a moment, but can we also discuss what we're fighting? Are we fighting passive flows that just couldn't care less?
Yeah, to a large extent. Look, passive investing has worked very well over the last decade or more in an environment of ever lower interest rates, where bigger companies are becoming increasingly dominant. And the US equity market itself has got the highest share of the world market since the early 1970s. So what's been winning has continued to win and win over time. And that's been a great environment for passive investment. We think that as interest rates stabilize at a slightly higher level, sure, they'll come down cyclically, but they won't come down structurally. Returns at the index level are going to be slightly lower. And that's an environment where the opportunity set is more attractive for active managers and also for more differentiation and diversification. And that means across regions, across sectors and styles as well.
Peter, when you talk about the case for international, I'm curious where you're looking in particular and whether it's regional-based or sector-based, as you were just noting.
Look, it's a little bit of both. I mean, the US has done extraordinarily well, partly because it's had a very high exposure to the growth factor, principally dominated by technology, which has been the winning sector over the last decade. We still really like technology. We think that the dominant companies have been justified again in their dominance because of incredibly strong fundamentals. But we think that you've got better relative valuation opportunities outside geographically the US. And indeed, last year, rather quietly, the Euro Stoxx 50 was slightly stronger than the S&P. Many people don't acknowledge that year to date, Europe has outperformed not just the S&P, but the NASDAQ. So has Japan. So it isn't that we don't like the US. It's gone up. It's done well. But there are geographical opportunities to diversify. And I think that means also broadening out from technology. We think technology is still going to be crucially important and do well. But as interest rates come down and we get this soft landing, the opportunity for broadening out into some more cyclical parts of the market is improving, but also into non-tech companies. We put together a list of what we call ETCs, ex-tech compounders. These are global companies outside of the tech sector, which have strong characteristics of reinvestment at a high rate, compounding high returns, and they tend to be somewhat cheaper and I think also offer good diversification opportunities.
Overnight, Peter, the Citigroup team, the equity team over there, actually upgraded EU stocks with about 6% more upside year to date in their view. And it's one of the highest on the street. This is the reason why. More certainty on rate cuts. We've been talking a lot about that. Global growth, you alluded to that, and dollar weakness. How much is dollar weakness necessary for this call to work?
Actually, I'm less convinced on the dollar weakness part of that story, although I agree with the other comments that you made. The European economy is growing at a much weaker pace than the US. We're looking at US growth this year of around 2.8%, and in Europe about 0.7%. But we shouldn't forget that the European companies that dominate the indices are very global, and therefore they benefit from a recovery in global growth and in the global manufacturing cycle, which is beginning to happen. And I think actually that what we find for European stocks is that growth trumps currency. If growth is accelerating, European companies tend to do well, even if the currency is actually stronger. Now, it may well be weaker, and that will add to its relative competitiveness. But we don't think the currency is actually the crucial part of this. It's much more about relative fundamentals, our earnings improving and as growth improving, our interest rates coming down. All of those things suggest they are. And Europe is only trading at around 13.5 times PE compared to something like 21 in the US. The UK only trades at around 10.5 times, about half the valuation of the US. And so there is a valuation opportunity as well, which isn't really dependent, I think, so much on currency.
Peter, when you look at India and China, you say India has good growth, China can be a value opportunity. A lot of people moved to India because they wanted to get away from China. Why do you see something interesting in both markets?
Well, I think that India is a bit of a different story. It's got high growth rates, both in terms of the corporate sector and in terms of the economy. It's a relatively expensive market, but it's one that has good exposure to long-term growth, and it is benefiting a little bit from diversification of supply chains and indeed diversification of investor focus away from China towards India. China is a bit of a different story. It is a valuation value play. I mean, the market trades at around 7 times earnings, much cheaper. Of course, it has a lot more structural headwinds and a higher risk premium given current developments. And it's much less, I think, of a consensus than India. But for a valuation-led recovery, if we get any policy stimulus, we think that there's reasonable upside, at least tactically, in that market as well.
Got to finish on Japan. Pete, it's just been amazing. Nikkei 225 year to date up by something like 22%. I think we had a move over the last year of something close to 50%. Pete, when I buy the S&P 500 market cap weighted, I know what I'm buying. I'm buying mega cap tech in a big way. When I buy Japan, Pete, what am I buying?
Well, I think there's 2 things to say about this. First of all, actually, just like the US, both Europe and Japan have seen an increased concentration by stock. So the biggest 30 companies in Japan, which are very global, are actually the biggest share of the 1,000 biggest that we've seen going back over several decades. So you are getting dominant, large cap, globally exposed companies doing very well. I think that the Japanese market is much cheaper than the US. Of course, it's gone up a lot, but we shouldn't forget it's only just broken through the level that it peaked at last in 1990. And the fundamentals are finally very different because you're getting expanding nominal GDP. We're finally coming out of the deflationary stagnation that's dominated that economy over the last 25, 30 years, but also quite a lot of restructuring stories because of bottom-up focus on improving return on investment from a low level. So with rising margins, return on equity going up, that justifies a bit more of a higher valuation. But the dominant companies there really are global companies in areas around technology, high value-added manufacturing that benefit from a bit of a pickup in global manufacturing cycle as well. And we think they're pretty well positioned, John.
Pete, always enjoy your thoughts. Thanks for being with us. Peter Oppenheimer there of Goldman Sachs on the latest. Looking for a little bit more Out of stocks internationally, Nikkei 225, 4 consecutive days of gains. We were talking last week, Lisa, about what would happen. What would happen if they hike interest rates, the yen rallies? What would it do to the Nikkei 225? So they hike interest rates, the yen did not rally.
No.
And stocks keep going higher.
Yeah, basically, this is the perfect combination for people to continue to be bullish because they can buy at a discount. And it looks like the currency is going to be on their side.
It's quite a run, more than 20% up year to date. In the next hour of Bloomberg Surveillance, we'll catch up with Mohammed Al-Arian of Bloomberg Opinion, Michael Shepard of Bloomberg News, Tracy McMillan of Wells Fargo, and Poonam Gaur of Bloomberg Intelligence. All of that and a whole lot more, with equities closing once again at record highs and adding just a little bit more weight to that rally this morning, up by 0.1%.
A lot of investors believe that the Fed is somehow a leading indicator. The Fed is a lagging indicator.
The first few rate cuts that we see are going to be driven by inflation.
In terms of inflation, we've had a supply effect that I think has been maybe even more important than the Fed.
There is a sense that it's not just the inflation point, but the supply point. Our expectation is inflation should come back down towards 2% with growth still being okay.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
At this point in the morning, I think we really need to catch up with an equity market bear because the bullishness of the first hour of this program has been absolutely overwhelming. We had Bob Michael at JP Morgan Asset Management with us in the last hour. Asked a very simple question: when was the last time you were this bullish? And he said the mid-2000s. Lisa on the edge of bullishness with almost nothing to say back to him when he was on the program.
Okay, hold on a second. Everything he's saying rings true. Companies, from everything that we hear, seem to be making good money. There are some nodes of caution, FedEx, for example. But on the flip side, how do you fight the Fed? And I'm not just talking about the Federal Reserve. I'm also talking about the federal government. How do you fight both prongs, basically printing money?
The enthusiasm is overwhelming. And we had new all-time highs in yesterday's session, even with Apple. The former Dalek of the equity market rally in America down by something like 4+% and losing more than $100 billion of market cap.
Absolutely, and this has to come when you have the DOJ going after Apple, saying that they have a monopoly and how they're structured, basically talking about how other companies, other apps, Jonathan, can't get into their software, can't get into the hardware. This, though, has been years in the making. And one thing I find fascinating about this is we talk about the upcoming election. Will anything change if it was to go back to Trump 2.0? It won't. This inquiry started in 2019 under the Trump administration. I think the direction of travel coming from Washington is very obvious.
Peter Oppenheimer of Goldman Sachs was saying, look for opportunities outside of America. SocGen have got very different views on this based on their upgrade very recently. Manish Kabra upgrading their outlook from 4750 on the S&P to 5,500. And in a couple of words, just in one single line, Bramo, US exceptionalism is going from strength to strength. Why would you want to fight it?
Well, here's the argument that people are saying, and this is actually exactly the point that I was cueing in on, which is basically you have the U.S. exceptionalism that everyone was talking about being outside of the rest of the world's weakness. It was the one bright light. And now there is a question, is U.S. exceptionalism not being tamped down by the weakness elsewhere, but actually expanding its golden rays across the world with all of the potential profitability traveling through worldwide? This is a key question. Yeah. Is it percolating outside of America, or is it remaining American exceptionalism that still hasn't been fully priced?
SocGen, despite widespread market optimism, we view this as rational rather than excessive. HSBC, a little bit earlier this morning, Lisa, this is not a bubble.
That's what people keep saying because the earnings are there. This, though, is really an interesting question. Are they talking about the equity rally? Are they talking about specific stocks that have gotten bid up very highly? Are they talking about, the equal weight? That, I think, is an important because some people are talking about, how there are certain names that maybe have gotten a little over their skis.
We'll discuss this hour. Equities right now on the S&P 500 positive by 0.1%. A little bit of a lift, big lift on the week, heading towards the biggest weekly gain of the year so far. In the bond market, rallying 2 through the week. Yields are lower by 2 basis points. Called it lower by almost 3 to 424.14 on a 10-year. And the euro weaker, dollar stronger, 108.18 on euro dollar. Coming up this hour, Mohammed Al-Erin of Bloomberg Opinion as stocks hit their 20th record high this year. Tracy McMillan of Wells Fargo on why she says it's time to reduce risk in portfolios. We've found one. And Bloomberg's Poonam Goyal as Nike says sales will be squeezed during its sneakers shift. We begin with our top story. Another day, another record. The S&P clocking its 20th all-time high this year on optimism. The Fed will be able to engineer a soft landing. Fed speak picking back up today with Powell, Barr and Bostic all on tap. Joining us now to discuss, the president of Queen's College Cambridge, Mohammed Al-Erin. Mohammed, let's get straight into it. How overwhelming is the enthusiasm of the last week for this market?
It's totally overwhelming, and for good reason, John. Initially, we had bottom-up drivers, secular themes that were very powerful. But that rally was narrowing. Now, suddenly, you have a very powerful top-down factor that has come in, enabling central banks that clearly are going to do what they want to do, regardless of selective data focus.
Well, let's talk about the Fed if we can.
These two things coming together are really powerful.
We did the pre-game together. We didn't do the post-game. So you were with us, fortunately, going into that news conference. Were you surprised by what came out of the news conference with Chairman Powell?
I was surprised by the extent to which he stressed patience in two ways. Patience with inflation running higher. He basically dismissed the fact that we've had some pretty surprising, hotter than expected inflation prints. And then the second patience with the balance sheet, saying, you know what, we may get there slower than we would have otherwise, which means that monetary policy is going to be more expansionary than it would have been otherwise. So I was struck that on the balance sheet, he took such a big step forward when he could have waited till the next meeting to do that.
So we keep wondering what shoe is going to drop, right? We keep thinking everyone's bullish and then more bullish and then bullish on top of bull. And you have to wonder, okay, well, when does something break? And we were talking on Wednesday, it's the inflation expectations, that at some point this is going to be a higher, more inflationary environment with a Fed that is less willing to fight it. And yet I'm not seeing it in break-even rates. I'm not seeing it in other places that you normally would. Why do you think that is?
You're seeing it in gold. Look at the reaction of gold, record highs on gold. I think what you're having is, and you've all said it really well, the everything rally. So it's going everywhere. What's interesting now is this notion of market enthusiasm, not economic enthusiasm. There's a big difference. Market enthusiasm could spread to the rest of the world. And that is quite a consequential statement. If that occurs, then the U.S. relative strength is going to be somewhat diminished. I think it's actually too early to pivot. I do think that, to use your phrase, U.S. exceptionalism, economic exceptionalism, isn't going to expand to the rest of the world. The U.S. is really exceptional when it comes to its economy. The others aren't doing what the U.S. is doing in terms of investing in the future drivers of growth. They don't have the entrepreneurial society that we have. They don't have the mobility of factors of production that we have. The U.S. is truly exceptional among other advanced economies.
So do you think it's rational for people to stay in the United States and to keep adding more, even if valuations are at such high levels relative to the rest of the world, to continue to kind of bet on this ship and not expect it to expand elsewhere?
So I've been asked that question every single year for the last 5 years. And every single year, the U.S. premium has increased. And every single year I said, don't fade the U.S. too early. I see some argument for diversifying away from the U.S., purely on this enthusiasm and on relative valuation, but I don't see it as strong. It is not being supported by fundamentals. People have to realize this. This is more betting on the momentum. And I understand that. The momentum factor is very strong right now.
You mentioned just a moment ago there's enthusiasm for the stock market. There's not enthusiasm for the economy. Well, how does that make any sense?
So the reason why it makes sense, and I've learned this the painful way, is that markets are not the economy. Markets can decouple from economies for a very long time. And we've seen that happen over and over again. But there are parts of the world, for example, one of the biggest puzzle is while you've had a surge into inflows in U.S. high yield and corporate bonds, investment grade bonds, you haven't had them in emerging markets. And people can't figure. So we have this very peculiar situation whereby it is U.S. investors managing U.S. investment-grade bonds that are taking off-benchmark bets in emerging markets. And I think that's because most investors think it's enough to be in the U.S.
You wear a few caps. Can we go to the Gramercy cap and talk about what's happening in the EM? What's the reason for that? What are you and the team over at Gramercy thinking about EM at the moment?
I think that people have been hurt so much, and people like, same reason why so many people are in cash, they think they can get adequate returns from safer places to be in.
If we were looking at EM and we saw a central banker that appeared to tacitly accept high inflation for longer, I think we'd be doing something very different with the assets of that country, particularly with the currency. Why is it different with the US?
Because the US issues the reserve currency, because the US is the place where people outsource their savings to be managed. The US can misbehave, quote unquote, much longer and in a much bigger way than any other country in the world.
Which is the reason why we've all been waiting for this to show up in longer-term bond yields and waiting and asking lots of people the question, and everybody says it's not going to happen because we're the reserve currency of the world. At a certain point, is the concern about inflation only going to show up in gold? Is this the only place, or will you start to see it wake up? Is that something that you're willing to bet on?
Look, we've set aside three concerns that are still in play. We just are not focusing on them right now. One is the US deficit and the tremendous amount of issuance. I remember being with you back in October where the question was, who's going to buy all these bonds? No one cares right now. So that's issue number one. Issue number two is we've taken a small step in Japan for exiting from a highly distorted monetary policy regime, and we have a really long journey ahead of us, but no one is asking the question, will Japanese investors have to sell all these foreign securities they've bought? And of course, the third one is the banking system. This is not a banking system issue. This is a few banks that are still facing difficulties, and that is going to play out this year, but it's not a banking system issue.
You talk about Japan, and let's go there for a minute, because they did come out with some inflation numbers overnight that were hotter than expected. And yet people aren't concerned because it seems like the BOJ put is as consistent as the Federal Reserve put in terms of not overhiking or being overambitious about how much to really tighten the screws. Does that make you think, you know what, even if that's a sort of outside threat, that's not going to happen? This isn't a normalizing cycle. This was simply kicking the goalpost a little bit further out the field.
So, Lisa, you're doing what John does, which get me on a Friday, and then I front run my Financial Times article coming out next week.
It's okay. No one's listening. Go on.
So I think we're going to look back this week, as the week in which central banks abandoned a point inflation target for a range. That we're going to look back and say this was the point when they realized, in the case of the Fed, for example, it's no longer a good idea to have a 2%, let's have 2 to 3%. It's going to happen in a very slow way. The first step was taken this week when you acknowledge that inflation will be higher, you acknowledge growth will be higher, but you see straight through it. Japan, same thing happened. So we're going to look back, and this is my hypothesis on this, as this has been a really important moment, but it's going to play out very slowly. Japan is going to play out very slowly. They will tolerate harder than expected inflation for much longer than anybody expected. Now, if you're in the equity market, that's music to your ear, as long as it doesn't get out of control. And so far, inflation expectations have been relatively well anchored, as you said.
Raises questions about what it means for the bond market. We'll talk about the consequences a little bit later. That was the greatest promotion that the FT's ever had, Mohammed. They'll be happy with that.
You do it to me every single week.
But it's good for everyone. We get a little bit, they get a little bit, everybody wins, OK? Don't they?
It's the everything rally.
It's the
literally
everything
rally.
Everything, yes,
literally.
Exactly. Thank
Okay.
you. Mohammed's going to stick with us, I'm pleased to say, through most of this hour. Let's give you an update on stories elsewhere this morning. Here's your Bloomberg Brief with Yahara Hackers. Hey, Yahara.
Hi, John. Reddit rose 48% in its trading debut yesterday, with the social media company closing at more than $50 a share. That's well above its IPO price of $34. Investor enthusiasm for the listing driven by the company's pitch to profit from the growth of artificial intelligence. Reddit's IPO is the fourth largest on a U.S. exchange this year. At market close, the company had a market cap of $8 billion. Investors took a $113 billion bite out of Apple's market cap following regulator moves against the company. The DOJ and 16 attorneys general filed a lawsuit accusing the iPhone maker of blocking rivals from accessing hardware and software features on the iPhone, a claim Apple strongly refuted. Across the Atlantic, the company is also said to be facing probes about whether it's complying with Europe's Digital Markets Act. And Tesla is pulling back electric car production in China amid sluggish sales growth and intense competition in the world's largest auto market. Sources telling Bloomberg the company instructed employees at its Shanghai facility to lower production of both the Model Y sport utility and Model 3 sedan by working 5 days a week instead of the usual 6.5. That's your Bloomberg Brief. John?
Yahara, thank you. Up next on this program, regulators closing in on Apple.
Apple has maintained its power, not because of its superiority, because of its unlawful exclusionary behavior.
That conversation coming up next. Live from New York City this morning. Good morning. Four-day winning streak on the S&P 500. Longest daily winning streak going back to early February. Adding some more weight to that. S&P 500 futures right now up by 0.15% on the S&P. Calling it the everything rally. Here's a little bit more of it. Bonds rallying, yield lower by 2 basis points. 4.2414. Crude up by 1/10 of 1%. $81 on WTI, and the dollar stronger. The euro down to 108.21. Under surveillance this morning. Regulators closing in on Apple.
Apple has maintained its power, not because of its superiority, because of its unlawful exclusionary behavior. Monopolies like Apple's threaten the free and fair markets upon which our economy is based. If left unchallenged, Apple will only continue to strengthen its smartphone monopoly.
It's the latest this morning. The DOJ suing Apple, accusing the tech giant of blocking rivals from accessing iPhone hardware and software features. Apple are raising $113 billion in market value. The iPhone maker pushing back, saying the lawsuit could, quote, set a dangerous precedent, empowering government to take a heavy hand in designing people's technology. Bloomberg's Michael Shepard joins us now for more from D.C. Shep, can we just start with the so-called Apple monopoly? What are they getting at here?
Well, what the Justice Department alleges is that there are certain features that people value in smartphones that Apple is tinkering with in a way that creates an advantage. This includes cross-platform messaging, say, between Apple devices and Android devices. It includes digital wallets and also support for non-Apple smartwatches. And then finally, also cloud streaming services. And what it is saying is that Apple is putting its thumb on the scale in a way that hurts not only consumers, but also the makers and innovators in these areas who are not named Apple.
Shep, the Wall Street Journal editorial this morning comes out and says the suit also claims Apple has, quote, suppressed mobile cloud streaming video services by requiring each to be submitted as a standalone app for approval. And they say LOL, as the kids say, because the FTC claimed that Microsoft Activision Blizzard acquisition would create a cloud video game monopoly. So is the DOJ, FTC, these regulators basically talking out of both sides of their mouth?
Well, that is, in a way, what it looks like, and that is certainly what Apple will try to argue, because when you parse Apple's statement from yesterday, and Jonathan was good to show an element, a segment of it. In short, they are saying that they're being punished for being innovative, for succeeding, and for drawing consumers. They say that, look, we don't blame us for people liking our products, for people gravitating to what we have to offer because of enhancements like security that people really value and that we're able to bring by setting higher and different standards for access to our App Store, for instance.
Let's talk about the politics of this. We have seen a robust regulation from the Biden administration, a more amped up DOJ, FTC. But this lawsuit, the inquiry of it started in 2019 under Trump. Do you expect, whether we get Trump or Biden, this is the direction of travel?
It's an interesting question, Annmarie, because we are in an election year, and there's a lot of questions about what the Trump administration, if he is elected to return to the White House, what a Trump administration would do in terms of its enforcement of the market. In this case, it's interesting. Donald Trump did not have a huge love affair with the tech industry, and the Justice Department under Trump also, as you said, started this case, but also pursued it on a lot of the same grounds that we are seeing here articulated by the Biden administration. And also in the Republican Party under Trump, there is a strong libertarian streak. We are seeing the party increasingly reject scale, in part because Trump is trying to make that appeal to the little guy voters, so to speak.
Shep, I got to say, I know it's kind of a fool's errand, but I'm looking for consistency. I want to understand what the framework here is in terms of what the desired outcome is. Is it national champions? Is it smaller companies? Is it, a democratization of tech? Is it trying to push up tech behemoths so they can compete with China? What is it?
That's a great question, Lisa, in the way, what is their end goal? And when you look at the president's platform, Bidenomics, the whole question of competition enforcement is important. And what they want to ensure is that innovation is not stifled, but that also consumers are not hurt. And it doesn't only apply to tech, although it's getting a lot of attention, of course, in the past few days with Apple, but it does extend to other areas. We saw the Biden administration's antitrust enforcers sued to block the Kroger's acquisition of Albertsons, for instance, trying to crack down on concentration in the grocery aisles. So there is something when you hear from the president's top economic advisors, when Annmarie and I in Washington have talked to some of the administration officials and asked them about Bidenomics, this whole question of fair competition to preserve innovation and fair pricing is something that is very much on their mind. I think they're thinking less of so much national champions than they are of trying to make sure the playing field is a little bit more equal. They are concerned that over the past few decades, we haven't seen as rigorous or robust antitrust enforcement as the public and innovators deserve.
Hey, Shep, great to hear from you. Michael Shepard there, down in Washington, D.C. on the latest with Apple. I'm thinking about who wins, Lisa. A lot of lawyers who are going to make a lot of money. And then I'm thinking of South Korea and China. I mean, who wins here? It's going to be foreign smartphone makers. That's who wins here.
And it comes at an interesting time ahead of what Samsung is expected to do, which is launch an AI-infused phone that's going to change our sort of experience, is what they are saying. And we have Apple racing to catch up with the Gemini partnership of Google. You just have to wonder, what's the ultimate goal? And if you don't have one, how do you sort of create enough consistency to give people the confidence to actually make deals, to go out, have a framework or rubric for their business? I mean, there's some real questions here.
This came up at Bank of America earlier this week. How do you get together and have a conversation about doing a deal where you feel like if you're about to be acquired and you sign up to that, you could be hung out to dry for a whole year, waiting for the regulator to decide whether or not it's bad for business.
And on the flip side, you've got a regional banking crisis that people say, well, there's just too many banks. There are too many banks, so you need to have more consolidation, but we don't want consolidation because we don't want to have dominance. I mean, it's sort of, it's a little bit mind-bending, so please forgive me.
Mohammed, let's talk about this. How interventionist is America becoming?
It's becoming more interventionist. I don't think there's any question about that. But the more interesting question is, does it need to be more interventionist? There is a view, which I must say I have some sympathy with, that industrial policy is going to be really important in pivoting from old-style growth models to new-style growth models. And you're seeing it not just in the U.S., you're seeing it elsewhere as well.
Well, and this is actually one of the reasons why, when we're talking about don't fight the Fed, the Federal Reserve, but also don't fight the federal government, because this kind of industrial policy is going to be crucial if you want to shift away from some of these supply chains. I remember maybe a year ago when people thought this would be inflationary. 6 months ago, people thought this would be inflationary. 3 months ago, probably going to increase pricing. Now people don't care. Why?
The reason why people don't care is because inflation has been coming down, and it has been coming down without a sacrifice in growth. So it's not a top issue right now.
But is it inflationary?
Yeah, sure, it's inflationary. Of course it is. All the restructuring that's happening in the global economy, other than AI, life sciences, are inflationary. The rewiring of supply chains for geopolitical reasons, inflationary. The rewiring of supply chains because companies want more resilience and not just efficiency, inflationary. What's happening in the labor market in terms of mismatches between skills and what people have, that's inflationary. So you have all this going on. On the other side, you have the promise of AI, you have the promises of life sciences, and people right now are completely focused on the promise and are willing to live with all these other restrictions ongoing.
We posed the question earlier on this week, and there was actually a really decent piece in the Wall Street Journal yesterday. I'm not sure if they've been watching Bloomberg Surveillance through the week or not, but whether America is becoming more like China, as opposed to an era where we believe China would become more like the United States. Is America becoming more like China?
That's like saying that I, as old and as unfit as I am becoming more like an Olympic athlete. Could I take a small step? Yes. But am I becoming anything like that person? No.
I'm not saying they're going to become full communist overnight in Washington, D.C. There might be some Republicans worried about that in the Democratic Party. I'm not saying that. I'm just saying we look a little bit more like them than they do us in the last couple of years, and that's not what we expected.
Well, we look a little bit more like Europe. We've realized that government has to play a bigger role in enabling the private sector, and we've realized that private-public partnerships matter.
Mohammed's going to stick with us. Coming up next on the programme, we found a little bit of an equity market bear, which is refreshing because everyone on this programme at the moment is very, very bullish. Tracy McMillian of Wells Fargo, as the S&P 500 hits its 20th all-time high in 2024. That conversation up next, live from New York City. This is Bloomberg. What a week for stocks. On the S&P 500, the rally continues. Equity futures on the S&P up by 0.1%, just about unchanged on the Nasdaq. They've been spoiled, though. All-time highs that are closed yesterday on the Nasdaq 100. The banks have been tremendous. Talk so much about tech and Nvidia. Stealthy rally in the financials. The banks on the S&P up for 5 consecutive days, up close to 5% so far this week, and some really decent gains year to date for the likes of JP Morgan, Goldman, and others.
JP Morgan coming out this week and saying it was increasing its dividend for the second time in 12 months. So just to give you a sense, they have so much money, they don't know what to do with it. They're just going to funnel it back to shareholders, which kind of gives you a sense of where we are.
I was looking at the year-to-date gains for some of the financials, up 17% on JP Morgan, up 19% on Citi. Bank of America up 11 over the last year. So you have to remember 12 months ago was like the ding-dong lows of the central bank malaise and regional banking crisis, if we can call it that. We can't call it that, can we? You didn't like that word. Regional banking stress of last spring. JP Morgan's up 60%, Goldman's up 36%, Citi's up 47%, and Bank of America's up about 40% since then.
This kind of relates, though, to the conversation we were just having, which is how much have they been gaining share from some of those regional banks that were facing, not a crisis, but stress, at a time when they really are the main players? I mean, again, it goes to this question of, is their strength a good thing, or is it sort of coming at the expense of those that some of the politicians want to protect? Really, it's a curious moment right now.
Well, the banks are doing better, that's for sure, as is pretty much everything else. I'm not going to weigh in on that.
I know, that was good.
Turn to the bond market, 2-year, 10-year, 30-year, just briefly. Here are the scores for you. Yields are lower by 2 or 3 basis points, 461 on a 2-year. We can finish on foreign exchange. First hike from the BOJ in 17 years, and dollar-yen on the week. We've had a move of 1.7% in the dollar's favour against the Japanese yen. So weaker yen on the week. Lisa, 151.57.
And it goes even to this point of we got hotter than expected inflation in Japan. And yes, we're seeing a little bit of yen strength, but not much, nothing to write home about. Honestly, Mohamed El-Erian's column that he's going to be publishing is a really good one about how there's sort of been a shift, a sea change with respect to the rate hiking cycle and the potential, or rate cutting cycle, and the potential of running inflation between 2 and 3% rather than 2%.
I was speaking to TK yesterday and I feel inspired. What does he say? Rip up the script.
Yeah.
Let's do exactly that.
Yeah.
Let's go to this piece that's coming out in the Financial Times next week. Let's spend a few minutes on that instead. What you said's really important, that perhaps central banks are tacitly accepting higher inflation rates without actually formalising this in any specific way, because some of these central banks actually need the government to do that for them. I just wonder what the consequences of that are going to be. And I'm with you, Mohammed. This week was the first baby step towards potentially, I stress potentially, something much bigger. We saw that in the contradiction in the 24 projections. And for those of us who maybe missed that, if you did, I'm happy to go through it again. The Federal Reserve came out with a median projection for 2024, unemployment a little bit lower, growth a whole lot stronger, and PCE, CPI, was revised a little bit higher. Inflation expectations were firmer, yet still the median jot showed 3 cuts for 2024. Now, we were trying to work out if that was just a small contradiction that they could iron out. Chairman starts speaking in the news conference, and he didn't seem fussed by it at all. Didn't seem bothered by the optics of it, the substance, nothing. What do you think we're going towards? And we mentioned the consequences. What are the consequences going to be for financial markets?
So, John, I think the critical thing is when he said the story has not changed. So we could have argued over 3 cuts versus 2 cuts. All you needed is 1 more member to move. It's furious accuracy. But when the chair says the story has not changed, when you've had 3 hotter than expected inflation prints and you've revised up your inflation projection, I think that's a real message.
Has the story changed for bond markets then?
Well, we see it in what's happening in the bond market. Yes, I mean, the bond market is now realizing that finally the curve is going to steepen, and it's realizing that we are going to tolerate higher inflation for a while, but that inflation is going to be well anchored. That is a really consequential statement.
So this is important because we've been trying to figure out if this is good or bad for the long end of the curve. Short end, if they want to cut, we know what happens. It's influenced by the policy rate. I think Lisa was first to ask this question following the news conference. What does it mean for bonds? What does it mean for the longer end of the curve?
And I remember sitting here with Priya Misra, and she said, don't take me there. I want to talk about the front end. I want to talk about the belly of the curve. Don't take me to the long end, because things get ambiguous when you get beyond 5 years.
Well, we're taking you there. What does it mean for the 10-year?
So I think for this year, an average 10-year yield of 4.25 around where we've been is reasonable. We're going to be quite volatile around it, but that's going to be reasonable. And the excitement is going to be elsewhere in the curve.
Which raises the question, is this the correct move? That basically it is important for the Fed to have a little bit more flexibility, and 2 to 3% is a more stimulative kind of environment for the economy to avoid the trap that we got into of disinflation for so many years.
So here we go full into the article now, okay? So,
paragraph, here we go.
To answer your question, it is not without risk, but it is the right move. It is not without risk because at some point you could destabilize inflation expectations. But it is the right move because we're living in a different macro paradigm. We're living in a paradigm where supply isn't flexible enough globally. And if you try to run a 2% inflation target, you will end up sacrificing economic well-being, unnecessarily so.
Does it concern you that some people are speculating, just to your comment about how markets are not the economy, that a lot of the inflation is asset inflation? It's not real world inflation because lower income families are the ones most likely to spend and are the ones who are least likely to really benefit from some of the rally that we're seeing in asset prices. How much does it just divorce financial markets from the fundamental economy in a way that could be potentially harmful?
I mean, that's been the story of QE. That's why there was a call for people's QE, the recognition that the generosity of the central bank was going to a very small group of people who owned assets. Look, let's not try to hide it. The low-income people have not recovered from a 9% inflation hit. Yes, their wages are going up more, but the cumulative impact of the inflation we've seen since 2021 has been significant. And if you don't believe me, go to food banks. Have a look at what, I talk to one food bank in particular, and they tell you they're still seeing long lines of people. So underprivileged segments of our society have been hit hard by inflation. The good news is that wages at the lower levels are going up faster than they have been in the past. But the inflation hit was painful. And that also explains why, despite U.S. economic exceptionalism, it doesn't get reflected in President Biden's polls on the economy. It doesn't get reflected because people remember inflation. And for many people out there, when you tell them inflation is better, they'll say, well, prices aren't coming down. They think that if inflation is better, then prices should be coming down.
So well framed. Mohammed, the second plug of the FT piece coming out Monday?
Tuesday.
OK, Tuesday. They're going to sell so many copies on Tuesday. The soft landing trade in full force. The S&P 500 notching the 20th all-time high of the year. We've found someone who's a little bearish. Tracy McMillan of Wells Fargo seeing risks ahead with a weakening consumer, cash stockpiles diminishing and delinquencies on the rise. Tracy, I'm pleased to say, joins us now for more. Tracy, I've been looking forward to this because everyone that's come on the programme so far is overwhelmingly constructive on this equity market. What don't you like? Let's start there.
Okay, well, I think to call us a bear might be a bit of an overstatement.
It's all relative.
Work with us.
Instead, I would say that we're medium-term optimistic. What we're seeing is that markets can't keep going up indefinitely. As you mentioned, 20th day this year that we have hit all-time highs on the S&P 500. I did the math. That's about 1 every 3 days we're hitting all-time high, so about a third of the time this year. So, that said, we could see some weakness, we think, through the summer as growth starts to slow down a little bit, and then we could see a rebound towards the end of the year. But we really don't see prices moving much higher than where they are today. So some weakness through the summer, then perhaps a rebound back to the levels where we are today by the end of the year.
So Tracy, the lesson of the pre-pandemic markets were that people had the frame of mind that you may get a sell-off, but it's going to rebound. And we never got those sell-offs because people immediately put money to work on any sign of a sell-off. Why would it be different this year?
Yeah, so we don't think it's going to be different this year. In fact, typically within a 12-month period, we do see about a 10% correction. So we think that that is possible this year. We do think that, we saw some really strong growth last year. The S&P 500, I should specify, is up 35% over the last year. And we just think it's probably time to take a pause there, and that would be an opportunity not necessarily to buy more large caps, because we're already overweight large caps, but potentially to broaden out exposure into things like small caps and potentially even emerging markets.
This is just amazing. The biggest bear on the street. We might possibly, maybe, see some weakness. Maybe.
We're not bearish.
I mean, I'm not bearish. You call me a bear is ridiculous. So here's my question. Is this ultimately a valuation story? Are you actually seeing weakness that people aren't recognizing, whether it's in companies or in consumers?
Yeah, so one of the things we have been pointing out is that the equity risk premium right now is very unattractive relative to bond yields. So valuations are high, absolutely. But, experience teaches us that that doesn't necessarily provide us with a good timing tool. So although valuations are high, they could go higher. So it can persist, especially if equity investors think that earnings growth has upside risk, which is what we think we're seeing right now. Does mean, though, that we think that stocks are increasingly priced for perfection. So that increases the chances that we could see a pullback on some disappointing news.
Does that mean that you're increasing your exposure to bonds? You say that there's probably a better risk premium placed on bonds. And I'm looking right now at investment grade credit spreads at their tightest level going back till November 2021. That still is more attractive?
Yeah, so we do think that bonds at 4.2, 4.5, 4.6, if we were to see that range, that's a good entry point for the long term. We are not necessarily adding to our bond positions at this point. Instead, we have already overweighted short-term fixed income, and we think that that will provide some additional cash to go into riskier assets, somewhere down the line when the opportunity looks more attractive.
Tracy, we were talking a few minutes ago about all this concern from a few months ago about issuance. We're going to see massive issuance. Who's going to be buying all those bonds? Has that disappeared?
I don't know that that has necessarily disappeared, because we are still running budget deficits. So there is still the need to fund those budget deficits. What did change was that the Treasury was issuing on the front end of the curve more so than the long end. So if they change their duration, if they change their maturity, then we might start to see those rates rising a bit. Our forecast for the end of the year does reflect that. We think 4.5% is a reasonable point to end the year. So yes, there could be some yield pressure from issuance. But at the same time, if the Federal Reserve does start to weaken or start to pull back on its quantitative tightening, then that could offset some of that as well.
Tracy, we tried. Thanks for being with us. Appreciate it.
Thank
Tracy
you.
McMillan, at the Wells Fargo Investment Institute. It's all relative, just not as bullish as everyone else. I guess it's bearish. Do you know what the most bullish forecast on the street was on the S&P at the end of last year? 5,200. It was John Stolfus of Oppenheimer. Do you know what we closed at yesterday? 5,241. Everyone's been playing catch-up through the year. And this has happened even with fewer rate cuts priced in than what we were looking for. And you remember what the story was. I know this, keep beating on the same drum, I understand. But at the end of last year, everyone was saying, this is the rally based on rate cuts coming. And we were looking for 6 or 7. And we might not even get the 3 that the Fed is looking for based on the economic data we've seen so far. And yet everyone's upgrading stocks.
And just to put a bow on it, Savita Subramanian of Bank of America, you've asked her every time she's been on, what's the biggest risk for you? Downside risk or upside risk? Still upside risk. And that's still where we're at.
What did Bob Michael say at JP Morgan?
Upside risk.
Upside risk. Mohammed, when was the last time you saw it like this? This environment, this market?
It's been a long time.
Bob said the mid-2000s.
Right.
As you reflect on things over the last few decades, what does it remind you of?
So it does remind me a little bit of mid-2000s, but there's also other things that I don't want it to remind me of.
A couple of years later?
Yeah.
Yeah, are we there, though?
No, not yet.
Doesn't feel like it. You say yet.
Yet.
Are you thinking we might be?
So people get carried away. I mean, look at the behavioral issue. Momentum is your friend, momentum is your friend, momentum is your friend, until it's no longer your friend.
Yeah, I don't like benchmarking to extremes, and I know you don't either, so I'm not saying that in 2 years' time we have anything like that, but where would you look for pockets of maybe things going a little bit too far?
So I go back to Anne-Marie's point, is that you need the fundamentals to continue to be positive. Not fully supportive because there's so much liquidity in the system still, but to continue to be positive. And then let's not forget there's all these other things. You know, if you were to bring someone to talk about geopolitics today, they would paint such a depressing picture.
Yeah.
And they would argue that there is no way that what happens in geopolitics stays in geopolitics.
The S&P 500 this morning, just about unchanged. Let's give you an update on stories elsewhere this morning. Here is your Bloomberg Brief with Yahara Hackes. Hey, Yahara.
Hi, John. Shares of Lululemon are lower in the pre-market after the athletic clothing maker forecasts a lower than expected sales outlook for the year. Plus, the retailer says visits to stores in the U.S. slowed in the first quarter and shoppers are buying less. Lululemon has had a stellar post-pandemic run, and analysts are sticking with it, predicting it will outperform its conservative guidance. FedEx shares are rallying in pre-market trading as the company's cost-cutting measures help deliver better than expected earnings. The courier is in the process of restructuring the company's delivery networks, part of a sweeping plan that includes shrinking its workforce by tens of thousands of jobs. FedEx also plans to buy back $5 billion of its shares. Also in retail, Nike warning investors sales will take a hit later this year, pushing shares lower in extended trading. The world's largest sportswear company says it's working to realign merchandise to better match what shoppers actually want to buy. Nike says revenue and earnings sees revenue and earnings growing next fiscal year despite the slump in the first half of the year. It expects to see a payoff from a $2 billion cost-cutting plan announced back in December. That's your Bloomberg Brief. John?
Yahara, thank you. We'll talk about some of the retailers up next. Up next on this program, a softer consumer.
What we're seeing now isn't recession on the horizon by any means, but the consumer is softer, but they're stable.
That conversation up next. Stocks pulling back just a touch. We're negative 0.1% on the S&P 500, lower in the last 10 minutes or so. In the bond market, yield still down by 2 basis points. A 10-year yield of 424.14. Under surveillance this morning, a softer consumer.
If we were talking a year ago, I would have said resilient, 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 resilient. I mean, there was nothing. What we're seeing now isn't recession on the horizon by any means, but the consumer is softer, but they're stable. They're softer and they're staying there.
Here's the latest this morning. Shares of Nike and Lululemon falling, with both retailers issuing a cautious outlook. Nike warning sales will take a hit later this year. Lulu saying U.S. consumers are, quote, a little soft coming into 2024. Poonam Gaul of Bloomberg Intelligence joins us now for more. Poonam, can we start with Nike? When Nike talks about positioning for where the consumer is currently, what are they talking about? What trends are they missing?
I think the biggest trend that Nike's missing is that through the pandemic, its innovation had slowed. So what they're trying to do now is bring back innovation to drive sales for the longer term. And as their product flow improves, so will their positioning in the market. You know, Nike is the largest sportswear retailer brand in the world. So for them to really keep that lead, they need to continue to push on innovation across all sports and across the globe.
Speaking of who's winning, who do you think is winning as they're not doing so well?
They're not doing so well. I think, you know, Adidas has come back a little with the new CEO under management. So we think they are taking some share back. We also have other footwear retailers that are coming up the mark. And that includes retailers like On and Hoka, right? They've been doing really well, taking share in the running and the lifestyle category. So we do think there is increasing competition in the footwear space overall.
Let's leave that year-to-date board up. And Poonam, go on, we've got to go. So we appreciate your time. Nike's down 7% year-to-date. Adidas is up by 8%. There was a big win in Germany.
Yes,
Did you see this?
Yes, I did.
I was kind of shocked by that.
This is awesome.
The German national football team, the jersey will no longer be made by Adidas. It's going to be made by Nike.
And what was so amazing about this story is that even the economy minister, Robert Habeck, came out and said, I don't like the way this feels. What about a little bit of love to some loyalty to the national team? But the German team is like, well, they were the most competitive. Economically, this made more sense. But it's kind of crazy to not see the three stripes on the German team, and they're going to go with Nike.
This goes back decades. Decades and decades.
Yeah, I mean, this was the national champion. Talking about national champions, Adidas. It's not Adidas, right? Are we going to have to call it Adidas now because they're no longer the national team and they're just going to have to be international in a new way?
This should be the poster child for the destruction of the German economic model.
Really?
This will be like, you know, the headline. This will be in my column this weekend. Gets published in the Financial Times Tuesday.
That's exactly, along with other columns that might come out.
Mohammed, let's get a final word from you. It's been quite a week, just looking around the world, all the decisions that have been made, a hike from the BOJ, a cut from the SNB, quite an interesting news conference from Chairman Powell. Just to recap the week, what stood out for you so far?
So before we get there, you know there's a huge controversy in England about the English shirt.
Oh, about the St. George Cross?
Yes.
I've seen that, yes.
Huge controversy.
They used different colours on it.
And I think different...
Was that Nike too? I think that was Nike, right?
That is Nike, yeah.
And they're refusing to recall it?
They think it's modern.
Oh, they think it's modern?
But the politicians are getting into the act right now.
So the politicians going to intervene?
They have intervened.
And what are they going to do?
They've expressed their opinion.
OK. And is that consequential?
I'll leave that up to you.
Can we return to markets?
Yes, what was the question again?
The question was, Mohammed, after the week we've had so far, I can do it again. Let's talk about the week so far. This is not scripted. BOJ's hiked, S&B's cut, Federal Reserve with a pretty interesting news conference. What stood out for you?
I think what stood out for me is that central banks took a significant dovish turn. And I think that is something that is not just cyclical, I think it's secular. And we're going to be talking about it for a while.
I want to just double down on this point that John was drawing out of you. If you haven't seen this since the mid-2000s, what takes us to 2007, right? I mean, not to sort of benchmark to cataclysmic events, and but there is this question of if it's an everything rally and people feel like nothing can fail, that can lead to difficult moments. How likely is that?
So you need a big shock. You need a really big shock, either an economic shock and or a political or geopolitical shock. On the economic side, I think we started to hear it. The consumer is driven by two things: net savings and income. Net savings has a orange light or yellow light flashing on it. Income is a green light. So if the labor market weakens significantly and income becomes an issue, then that would be something on the economic side. On the geopolitics, you can imagine something that drives oil up to over $100 a barrel. That would be a big shock.
Well, why is all this discounted? There's two hot wars. 90% of the American tech giants, their chips are manufactured in Taiwan. There's so many different areas or pockets around the world that are brewing with tension, and it's not playing out in the markets.
So let me tell you a story. 2008, the beginning of 2008, a really respected banker comes and sees me, and I ask him, where are we in the cycle? And he draws an upside-down U, and he says, near the top. And I said, what's your risk position? He said, fully risk on. I said, how could you be fully risk on when you're near the top? He said, 3 reasons. I don't quite know where the top is. 2, everybody's also full risk on. 3, I can get out in time. That bank had to be saved. So I'm just saying that the attitude of the markets is that you never know where the top is. You don't want to miss out. You're being judged on a high-frequency basis. And there's this almost arrogance that we can all get out when it matters. So it can run for a very long time.
So the final question then, Mohammed, should be, and I want to jump in because we've got 60 seconds left, that's your experience at PIMCO. PIMCO in that time became the cash machine because you didn't get into trouble. What were you identifying, which goes back to Lisa's question, what did you identify at that time that made you take a very different position in markets?
So, you know, PIMCO tends to be early, and it certainly was early on the housing call, but it stuck to its guns, and that's the advantage of being a long-term investor, and in the case of PIMCO, having clients that have been there a very long time. Now, other firms don't have that confidence of taking a longer-term view that PIMCO has, and that's been the magic that Bill Gross really wired into the system through structure.
Mohammed, this was fascinating. I'm going to go home and re-listen to a lot of these conversations. Appreciate it. And if you want to hear from more from Mohammed, you can on Bloomberg.com. It is Bloomberg Opinion column.
On Tuesday.
And I've heard something's coming out Tuesday morning.
Yeah, your column.
In the print edition of the FT. Only available in the City of London. Is that true?
No.
Maybe it's no, it's not true. You can get it elsewhere. In Northern England as well.
Yeah,
That's good.
true.
Good to know. Great. Coming up, Sarah Hunt of Alpine Saxon Woods, Kim Wallace of 22V Research, Sophia Drossos of Point 72, and a whole lot more.
The everything rally is likely to continue for a little bit longer.
I think stocks can continue probably to do well, high-quality stocks, though.
The winners themselves, when momentum is high, can continue to do well.
There's still very much a speculative fervor within the market.
We've been bullish. We remain bullish. We still, very much seem to be in this sweet spot.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
One last one for Bramo. Let's get you to the weekend.
Thank you.
Live from New York City this morning. Good morning, good morning. This is Bloomberg Surveillance. I'm with you. This week is fat exhausting in this market in a major way. Equity futures on the S&P 500 negative by 0.1%. 4-day winning streak on the S&P 500. If you're just joining us, welcome to the program. Here's a flavour of the last 2 hours. Bullish. I mean, seriously. Really bullish, really constructive. Let's start with Bob Michael at JP Morgan. Bob Michael comes on a program so bullish on almost everything in fixed income. We ask him a very blunt, straightforward question. When was the last time you were this bullish? He sat there, he thought about it, and he said the mid-2000s. We asked Mohammed Al-Erin about it. Same question, reflected on it a little bit, said the same thing.
That question that you asked, really, to me, is the theme of the morning. How far do we have to go back before we start to see this type of all-encompassing bullishness? Yes, there might have been consequences down the line, but it took long enough for people to make a whole lot of money in the meantime, and that seems to be where we're at.
You hear things like that, and it makes you feel uncomfortable, but it's been upgrade after upgrade on Wall Street on the S&P 500. We had another one from SocGen, Manish Kabra, taking year-end price targets from 47.50 out to 5,500. US exceptionalism is going from strength to strength. Despite widespread market optimism, we view this as rational rather than excessive. This is not a bubble. This is not a bubble. How many times have we heard that in the last few weeks?
Which brings us to the Max Kettner note of HSBC, where he's talking about this is not a bubble. To me, it raises this question, and he answered this. There's a lot of early cycle types of behavior in terms of economic strength, different corporate cycles that he's observing. Where are we in this cycle? We thought we were late cycle last year. Now, all of a sudden, we're early cycle. That, I think, is infusing the optimism, feeling like this has a lot more to go with money coming out of all spigots.
What Mohammed said, I think, was really important. He said you speak to financial market participants at the moment. It's overwhelming, just overwhelmed by happy talk whenever they talk about financial markets. Speak to an expert on geopolitics, he said. You'll have a very, very different conversation.
Very dark. It's very different than the optimism momentum you're seeing in the equity markets and the markets overall. When you look at geopolitics, Jonathan, and it's a good point to bring up today because we do have Secretary Blinken in Israel, there's two hot wars right now in the world. And any one of these can also have a huge impact on commodities, which can have a huge impact on inflation expectations. But then, of course, you look back at the tech darlings of the United States. 90% of them, when they get their chips, is exposed to Taiwan. And that is obviously brewing tension in the South China Sea with China.
The problem is that none of it's really panned out, right? And it hasn't worked for the market. And so it raises this question, are we essentially going to become increasingly fragile as we keep, going with the momentum? until something happens that we cannot predict and that we cannot plan for. So that's why I'm still hiding in a bunker.
Well, right now, not much is happening.
Oh, phew, she's
I have
bearish
to say,
again.
I said earlier on as well, very close. We're getting closer. Lisa is almost bullish. Equities right now, but still in a bunker, right? Kind of.
Always.
Sure. Equity futures on the S&P down by 0.2%. Yields lower by 3 basis points, 423.55. In the FX market, dollar strength against the euro, 108.16, just about holding on to 108. We're negative on that currency pair by 0.4%. Coming up this hour, Sarah Hunt of Alpine Saxon Woods on the Fed-fueled rally. Kim Wallace of 22V Research as Congress races to avoid a government shutdown. And Sophia Drossos of Point 72 on the Fed's path forward. We begin with our top story, the Fed-fueled rally, pushing stocks to fresh all-time highs. The S&P 500 hitting its 20th record so far this year. Not even tech losses led by Apple or Alphabet curbing market momentum. Sarah Hunt of Alpine Saxon Woods saying this: the Fed meeting this week seems to have confirmed that the central bank is also on the soft landing path and gave markets enough to imply that even with elevated inflation readings in 24, the path is still open for lower rates. Sarah joins us now for more. Sarah, just how constructive have you become after what you heard from Chairman Powell this week?
I think it's difficult not to be constructive given the fact that you had this. So first we had it in December of last year, right? We had all this concern about a hawkish Fed in August and into October. And then in December, they basically said, or Chair Powell basically said, you know what, we think the risks are balanced. He had a chance this week to come out and say, you know what, we think that there's been some, irrational exuberance or over enthusiasm, and he didn't. And I think that that just says the Fed is comfortable with where things are going now, sort of overlooked the higher inflation readings in January. That has to be positive for equities. If the path is still lower, and not only is not higher, we're still saying it's lower. We're not even saying we're not going to do it. The fact that we didn't go to 2 from 3, that might change this year depending on what happens. But in the scheme of things, I think that that was pretty much an okay, go ahead and keep buying things.
We've labelled this week the everything rally. We've been buying almost everything, not just things, including banks. Banks are up this week on the S&P by something like 5%. What are they rallying on?
So I think on the bank side, I think that there was this issue that happened in March of last year with Silicon Valley Bank. I think what the banks are realizing is that even though we keep hearing these really dire commercial real estate stories and really dire stories about you've got this big refunding, we've got all this debt has to be termed out, I think that there's a realization that the odds are that if something does go wrong, there's going to be a backstop for it. And I think that that makes people feel better about banks. Now, that's not been explicitly said yet, but I just think if you take the totality of the evidence, that the odds are that you're going to get something done if you see some sort of a crisis in commercial real estate, which we do keep hearing about. We keep hearing the valuations are lower and people have extended and pretended. But the fact that you've got private credit being able to do that may just let that be less of a crisis than we were all expecting.
So does this basically mean that there are other areas as well that could really benefit from the Fed put that essentially you're saying is implicitly being thrown into the market in a massive way that you're kind of leaning into?
Well, I think that that's where you switched. I think that in August and September of last year, you were worried that the Fed put was gone, and now it seems that the Fed put is back. And I think that it's hard to argue against that, right? It's the don't fight the Fed idea of where they're going, then markets are going to follow. I can list a whole bunch of things to be worried about, but you're right, a lot of them are not playing out. And the global political scene is a disaster. And so there's plenty of things that could happen, but could is not, I see a line and I see a time and I have a catalyst.
How much are you doubling down? How much have you actually shifted allocations and bought banks, bought riskier credit, bought everything after that meeting?
I think the answer is more, what didn't we do when things were ugly, which was sell those things? So you keep those things, right? So it's not like you had to double down into technology because we were already there. And we saw some of the things that happened in 2022, but even in August and like when the market cracked last year in September, October, just not shifting out of things and trying to get into the safer bets at that point would have been a more difficult thing from a performance standpoint as you came into 2024, because December happened and that market just hasn't really looked back. I mean, it's had a couple of little fill-ups, but it hasn't really looked back.
It's been amazing since the end of October. It's just been a phenomenal run in this equity market. I think we've had 3 weeks of losses since the end of October, and 2 of them were the previous 2 weeks, and we've taken it all back this week and some.
What was that statistic, that a third of the days that the S&P has traded has been at record highs? Just to throw that out there. I thought that was pretty amazing.
20 record highs so far this year.
It's just phenomenal.
It's just been absolutely amazing. We caught up with Goldman Sachs earlier this morning. Goldman said, look elsewhere. Get away from the dominance of the concentration of US equities, big cap tech, look to Japan. What do you say to that?
Well, I think, it was interesting when the Bank of Japan changed their policy and the yen didn't do what people had expected it to do. So that's positive for their stock market, right? Because if the yen had strengthened too much, then people get worried about the currency movements. I think that it's fine to look outside, but you also have to be careful because if anything is going to derail the U.S., it's going to derail outside too. It's not going to be the U.S. goes down and the rest of the world says, okay, everything is great, even with these massive valuation discrepancies. So I think that there's room for other things, but you have to think about them as all kind of working together.
I just want to frame that a little bit more tightly. Are you saying the US can decouple from the rest of the world, but the rest of the world can't decouple from the US?
Yes. That wasn't how I was framing it in my mind.
Well,
but
I'm
yes,
just thinking that through.
That's
so
basically,
is it always the obvious bet just to own US equity risk if you want to own any equity risk at all?
From our standpoint, it's very difficult to think of not owning U.S. equity risk. You can add other things to it, but especially as a U.S.-based investor, it is very difficult to think I'm going to swap out of the U.S. and go to other places just because I'm worried about the valuations in the U.S.
All right, let's stay on American exceptionalism. We've been talking about how long we can have this privilege to keep borrowing endless amounts of money while also fueling our economy through that kind of financing. Does the Fed pivot make you less optimistic on longer-term bonds? The question John was asking earlier, because it does sort of imply a bit of a higher inflation target and a bit of more tolerance by the Fed to price instability.
Well, I think that what it does is it means that you're not going to go back to zero interest rates. So that gives bonds a place in a portfolio. It gives bonds a place in a portfolio, especially if you have a demographic that's older. You don't want to only be in equities because there is that risk there. And I think that the bond at this point has less risk to it because of the Fed's dovishness. But you also are long-term bonds going to go a little bit higher because the economy's better? Or are they going to go a little bit higher because they're worried about the U.S. financial system? And I think that this is the joy of having the reserve currency, is that you have a lot more room to act within that than a lot of other countries do.
One thing that Mohamed El-Erian was talking about was that the one place where you're seeing inflation concerns is in real assets, in particular gold. How much has this turbocharged your enthusiasm for things like oil, for things like metals, for things like gold?
Well, I mean, I've always had a little bit of a predilection for gold. Most clients don't like that, so I can do that more personally than I can in other ways. But I think that, there is an argument for debasement of global fiat currencies coming out in other places, and that will come out in things like gold. It will come out in things like commodities. It will come out in things like the coins that we don't talk about. It will come out people will put a view on that by buying things where they feel like there's a difference than just the fiat currency. But again, the U.S. having the reserve currency makes a huge difference in how we can act, and other people can't do that. And even if it is a race to the bottom, the U.S. still ends up in a privileged position.
We noted 2 all-time highs on Wednesday in that news conference. One was stocks, the other was gold. Gold, I think, is really notable. What's happening there in the last few weeks?
And the fact that this might be the inflation hedge or the concern about, as Sarah was just saying, the debasement of fiat currency.
Sarah, good to see you. Thanks for catching up with us. Sarah Hunt there of Alpine Saxon Woods. Equities at the moment doing OK. All-time highs coming into Friday, down just a little bit. Equity futures negative by 0.1%. Let's get you an update on stories elsewhere this morning. Here is your Bloomberg Brief with Yahara Hackers. Hey, Yahara.
Hi, John. Ending the fentanyl crisis is shaping up to be a high priority for voters ahead of the U.S. election. A recent Bloomberg News Morning Consult poll sees about 8 in 10 swing state voters ranking the problem as an important factor in deciding their vote. That's more than the number who cite abortion, climate change, labor, or the wars in Ukraine and Gaza. Fentanyl has been linked to more than 250,000 deaths since the start of the pandemic. And FedEx shares are rallying in pre-market trading as the company's cost-cutting measures help deliver better than expected earnings. The courier is in the process of restructuring the company's delivery networks, part of a sweeping plan that includes shrinking its workforce by tens of thousands of jobs. FedEx also plans to buy back $5 billion of its shares. And BlackRock is calling a Texas decision to pull $8.5 billion from the asset manager's funds reckless. The Texas Board of Education says BlackRock's involvement in environmental, social, and governance, otherwise known as ESG, makes investments ineligible under state law. This is one of the biggest actions taken against BlackRock as states with Republican leaders push ahead with an anti-ESG campaign. BlackRock denies any wrongdoing and says the company holds more than $320 billion in energy investments, including in Texas-based companies. That's your Bloomberg Brief. John?
Yahara, thank you. That story, it's just the beginning. This has been brewing for a while. Saw it a little bit in Florida, seeing it in Texas. not going away anytime soon.
It's not. And it's actually just going to ramp up, especially as we head towards the November election, Jonathan. What you hear from companies is it's really hard to decipher how to do business, whether it's a blue state or a red state.
Going to get harder and harder. Up next on this program, Congress racing to avoid a shutdown.
Democrats have repeatedly made clear that we will find bipartisan common ground with our Republican colleagues. Under no circumstances can we tolerate a government shutdown.
If market participants had a list of things they didn't care about, is this one at the top?
Yeah, the market shutdown that never happens, or
Right,
that it
just
does, doesn't matter.
Right up there. That conversation's up next. This is Bloomberg.
Talk about it.
Equities pulling back just a touch. We're down 0.1% on the S&P 500. Into the bond market, yields are lower by 5 basis points on a 10-year, 421.78. Under surveillance this morning, Congress racing to avoid a shutdown.
From the very beginning of this Congress, Democrats have repeatedly made clear that we will find bipartisan common ground with our Republican colleagues. We're prepared to do it once again in order to make sure that the final 6 appropriations bills are passed and on a path to be signed into law. Under no circumstances can we tolerate a government shutdown.
It's the latest this morning. Lawmakers racing to vote on a $1.2 trillion bipartisan spending package, which would keep the government funded through the end of September. House Speaker Mike Johnson once again facing opposition from within his own party as the GOP majority is shrinking further with the early departure of Congressman Ken Buck. Both chambers have until midnight to get the bill to President Biden. Kim Wallace, Washington policy analyst at 22V Research, joins us now for more. Kim, this might be the shortest segment ever because market participants look at this and just sort of glaze over and they're like, really, again, this? Do we need to care about this?
No, you don't.
Let's move on. Kim Wallace at 22V Research, thank you very much for joining us.
Thank you and good night.
Why is it so much easier now for this speaker than it was for McCarthy?
Oh, I think because we're nearing the election and he's got a shrinking margin, as you've noted. But more importantly, as Tom Cole, the chair of Rules Committee, said 2 or 3 weeks ago, the deal that was cut in May 23 on top-line spending has been substantiated 4 or 5 times now since then. So you roll all those together. There's no play here.
What about October 1st?
You know.
Something to worry about.
So we'll get there again, but you have bigger things to worry about in the market. The previous 2 segments, is it growth or is it a head fake? And if it's growth, do we have to worry about what that means for policymakers and fiscal policy? Yes and no. Not now, but in December we go through debt ceiling again. That's when you begin to pay attention to Washington. December, not before.
So if it is growth, what do they do between now and the election?
Tread water. There has been rising bipartisan agreement on the U.S.-China competition front. So yesterday we saw the House pass 393 to 24, legislation that would require a review of all ships at U.S. ports to check them for cybersecurity risk because those ships and much of the cranes on those ports were built in China. So, you know, we've got substantive stuff going on, but that's not what gets the headlines.
And what about Ukraine? Because that has still been a stalemate.
Slowly, tortuously, they're headed toward where they've been for the last 6 months, providing assistance to Ukraine and Israel.
You talk about how they're bigger fish to fry, in particular, the sort of bipartisan effort for the U.S. to compete with China. I'm wondering if we're having a cohesive kind of policy shift here, or if it's kind of just ad hoc, throwing things at the wall to see what sticks and what sounds good, but doesn't actually come together in something that businesses can really plan around.
Lisa, it's a good question. We'll have to answer it next year after the election, because the U.S.-China competition generates a lot of noise, but it also points to a lot of deficiencies in the U.S. manufacturing base. Shipbuilding, chips. We've got defense industrial base. Deputy Secretary of Defense Kathleen Hicks 2 days ago addressed defense industrial base and how far behind we are. Chief Naval Officer almost a week ago said, you go through history, nations that can build ships, have navies, have commerce. It's connected. we're behind. We're way behind. We were number one in shipbuilding in 1975. We're 19 now. It matters. And it will matter more as we have the great power friction.
A lot of people point to the fact that the U.S. is at the bottom of the list in terms of industrial spending more generally, even with the recent spending packages that have been approved. I'm just wondering, though, how much more appetite is there, as well as capacity for this country to borrow more, to invest more, as so many people are basically betting on in markets?
So Washington is going to have to start multitasking. But after the election, yeah, I know it's scary, but it's real. They're going to have to decide the path forward in fiscal policy that also includes a pro-growth stance. We did it in the early 90s. We reduced deficits just as we were having desktop publishing or desktop computing coming from Microsoft. It helped the boom of 1990s. It's in front of us now. We have technology that could be bleeding edge, that might be applicable across many sectors. And we have a fiscal problem. Those are just votes. Those are decisions on the way forward. That doesn't do away with the challenges you have geopolitically, nor the deficiencies that we've had across our industrial base that make those challenges worse.
It begs the question, why are we going after our national champions in the United States? Why aren't we supporting them? Why are we going after the likes of Apple?
The short answer, John, I think, is maybe we would have 20 national champions instead of 7. If we had better competition in that space. That's not a view, that's just what you hear from some of the competition policy analysts.
What was your reaction to the DOJ's case unveiled yesterday?
It's been brewing for half a decade, and given the DOJ's press release, they seem to think they have a very strong, multi-layered case. The courts will decide. It cannot be that we've had these fantastic tech companies for the past 20 years, and increasingly their network effect has resulted in power for them in the market, and that not stunt competition. The question is, has it been illegal?
The chief antitrust head under the Trump administration, Makan Delrahim, he had notably said that these technology companies are, quote, digital gatekeepers, very similar to what we hear out of this current DOJ. What do you expect? Where can this all go, basically, if we get Trump back in the White House? Or do you think this stays the same?
Annmarie, we don't know. If Trump is back in the White House, you have to ask the question when he's back in the White House, and you have to ask it almost every day, because he changes his mind based on how he feels on topics and based on with whom he speaks and their interests.
You said wait until the election, and I was sitting here thinking, well, do we need to wait until the election? Don't we know what both stand for on these issues? And isn't this administration quite similar to what we saw from the former administration on a number of these topics too?
I like the first half of that, in that we are nearing in this country a very stark choice. I would push back strongly in a long time that they're very similar. In trade, you see some similarities. They're protectionist. But if you look at the strategic level, it's different. Whole of government versus rifle shots.
Give us an example of that.
Well, the tariffs, both on steel and agriculture. That was the brunt of the U.S.-China competition under Trump. When he was about to ban ZTE and Huawei technology and hardware from the U.S., he was contacted by people in the U.S. who knew him, who had positions in those companies. He backed away, similar to TikTok. So it's strategic versus what you feel like at the moment.
But the
in my view.
But the Biden administration kept those tariffs in place, and
Yeah.
Trump is weighing potentially even more aggressive tariffs.
Yeah.
10% wall overall for the world, and more than 60% from China specifically.
True, but when you look at geopolitics or even trade, those tariffs are a very small part of the overall story, very small part. And the two men approach that question very differently.
What do you think the approach is going to be regarding China in the near term then, specifically for Biden, regarding EVs? I think this is a really important topic. What happened over the weekend, a lot of news organisations went for this headline about bloodbaths. And I think the story for us was actually the president, just before that, the former president talked about a 100% tariff on Chinese EVs. The former president talks about tariffs. The current president talks about protecting union workers. What do you think he can do between now and November to do just that, attack the same thing?
The current president?
Yeah.
Make promises. And that's all he can do. And see that his Inflation Reduction Act continues to unfold. We have to accept the fact that the U.S. is way behind. And if they're going to compete, industrial base, technology, we'll be talking about this for a decade in terms of the catch-up.
You say promises. What will those promises be?
Promises be that if you re-elect me, I'll double down on boosting the defense industrial base. $60 billion in his first supplemental request. Hicks, in her speech, reiterated that same $60 billion and broke it out. So you have to ask each candidate, what's your plan?
And we will, if they join us, Kim. But as you know, they like joining their own respective TV networks, which is what happens in America quite often.
Thank goodness that opened space for the others.
I know. Kim Wallace, thank you, sir. Kim Wallace at 22V Research. Coming up on this programme, point 72, Sophia Drossos on the Fed's path forward. That conversation just around the corner. Equity futures on the S&P 500, negative by 0.1% in the bond market. The rally continues there. We're down about 5 basis points on a 10-year to 4.21, and a 2-year, we're down 3 basis points to just about 4.60. From New York City, this is Bloomberg. Let's attempt to wrap up the trading week and give you a flavour of the price action on the session and over the last week as well. 4 days of gains on the S&P 500. Small morning of losses. We're down by 0.15% on the S&P. Negative by 0.3 on the Nasdaq. Both on the S&P and on the Nasdaq. All-time highs at a close on Thursday. We switch on the board and get to the bond market. Snapshot of treasuries for you. 2-year, 10-year, 30-year. Yields down across the curve. More so on the long end, down about 5 basis points, 421.58 on 10s. On 2s, quite a round trip this week from the 470s on Monday. Lisa, briefly, the 450s through the middle of the week and back up to 460.41.
The Fed puts back. The Fed's got the markets back. That's essentially the message that the bond market keeps taking. We've been asking all week, what about the long end? Does this make sense in the long end, given the fact that there's a tacit understanding that inflation might run hotter for longer, and that's okay? And everyone's saying, we're not really getting a clean answer from anyone.
They are pointing to gold, though. Gold
Yes.
maybe just sort of picking up on the scent of that, just a touch.
It seems like there's a wall of money. And this is what people are struggling with. Something that might make sense in theory doesn't work in practice just because there is so much liquidity that people say is looking to find a home. Bob Michael was talking about just people buying more equities, people buying more credit, but the cash balance is still going up. So how do you put this together and come up with some thesis that's going to really play out in markets?
We've said basically anything with a dollar sign this week has done well. I mean, I know that's a stretch, but it's felt that way. Stocks and bonds rallying. $2, strength in the whole of G10 with the exception of the Japanese yen this morning. Yen showing a little bit of strength. Dollar yen down by 31%, 151.16. Stronger on the session, weaker on the week. And I think the week has been the story, Lisa, not today.
They did it. They raised rates to zero. Woohoo! And guess what? And you wouldn't know it because they also effectively say that they're still doing yield curve control. They're just not calling it yield curve control, and they'll come in if they need to. So even though we got a hotter than expected print with respect to inflation in Japan overnight, doesn't matter because the Fed put, the BOJ put, central bank put seems to be back in play.
We've got some time this morning still to build on this, but what Mohamed Al-Erin said a little bit earlier this morning, that just the early signs of a long, long game, but the early signs, the first few steps of maybe accepting a higher inflation rate without actually being mandated one, which I think is going to be controversial in some circles.
But that's essentially what Jay Powell said. He said emphasis on take a while, or with the words I'm lost in my head. But my question
long week.
Thank you. Yes, long week. There's this question of how long they will be patient and allow inflation to drift down to 2%. If they allow it to be north of 2% for 10 years, has their target changed?
We'll come back to those comments in just a moment. Under surveillance this morning, some of our top stories for you. Regulators hitting Apple at its core. The DOJ and 16 attorneys general filing a lawsuit accusing Apple of blocking rivals from iPhone software and hardware features. The tech giant losing $113 billion in market value in yesterday's trading. Meanwhile, the EU is preparing to investigate the company over the compliance with the Digital Markets Act. Apple shares down about 11% year to date, underperforming both the S&P and the Nasdaq. AMH, this is the interesting feature of this, and of course there are many interesting dimensions to this story, but typically we were accusing the Europeans of going after the darlings of US tech, and now it's the Americans going after their own babies.
Yeah, it is, and this increase started in 2019 under the Trump administration, so it's been years in the making, and what is so interesting and potentially why you see the stock sell-off is that it is really comprehensive in how much they're going after everything that is integral to the iPhone. It's messaging, how they deal with digital players when it comes to the wallet, cloud services. But years in the making, I think years in the making as well in terms of what is going to be the remedy for this. And there was a briefing call yesterday with the DOJ, and they didn't take off the table this idea of a breakup.
Who wins if the DOJ is successful? maybe China. Chinese President Xi Jinping set to meet with a group of US business leaders next week as Beijing looks to attract foreign investment. The list of participants isn't complete, but the president of the National Committee on US-China Relations and president of the US-China Business Council are expected to attend. US executives are already heading to Beijing this weekend for the China Development Forum. According to the Wall Street Journal, those names include Apple's Tim Cook and Blackstone's Steve Schwarzman. This is the charm offensive. And the big data point that I think matters here regarding this story is FDI. And that number is not a pretty one for China.
It's been negative, and the most negative that we've seen really going back decades. There's a real question here of how much executives are going to actually hear what Xi Jinping has to say and how much the executives who are going there are being forced to hear what he has to say because of how much of their businesses are dependent on the China economy. Tim Cook.
Good point. Whether or not they like it or not, do they have to show up? But I was with Xi and Biden in San Francisco. Remember that dinner they hosted? $40,000 to sit at Xi's table. So this is probably going to be expensive as well.
Yeah, they paid up for it. And I think the fact that Tim Cook was in China this week as this was unfolding with the DOJ in Washington kind of tells you what's important to them right now.
They're tied to it from a demand standpoint, and they're tied to it from a manufacturing standpoint. They can't get away from it. How many other Tim Cooks are there? Not as many as there used to be, but it's really a difficult thing to extricate these two economies that are the world's biggest.
Apple, the big mover yesterday. Let's finish on this with Nike and Lululemon under pressure, both anticipating challenges in the US market. Nike warning investors sales will take a hit this year as it recalibrates its merchandising lineup. The company shifting its sneaker offerings to better match customer demand. Lululemon seeing a sales slowdown to start the year thanks to lower foot traffic and shopper pullback. The activewear company focusing on expansion in China as competition rises stateside. So I guess that kind of reinforces the conversation we just had.
At the end of the day, it's a very populated country that has a lot of money. It's where businesses want to be. At what point are they really going to be so hesitant to get in because of the geopolitics when, you know, there are dollar signs there or yuan signs?
Those stocks are struggling. Let's push forward. A slew of Fed speak on deck today. I like that.
Thanks.
Including Fed Chair Powell, Vice Chair of Supervision Michael Barr, and Atlanta Fed President Raphael Bostic. Sophia Drosos of Point72 weighing in on the FOMC's path forward, writing, quote, "We continue to look for 3 rate cuts this year, starting in June and continuing at a quarterly pace. The Fed will be cutting rates as inflation falls, but growth remains above trend. That should prove supportive for broader risk sentiment." I'm pleased to say that with us around the table is Sophia. Sophia, good morning.
Good morning. Thanks for having me.
What a week. Mohammed was on the programme with us about 30 minutes ago, and he was talking about central banks almost tacitly accepting higher inflation rates. Is that a view that you'd endorse this morning based on what you've heard this week?
Well, what I would say is that central banks are starting to focus perhaps a bit more on other aspects of their mandates, and they're supportive of the idea that inflation has come down and they are making progress on that front. And so we are seeing policy shift. And what I think is very interesting, I have never seen it in my career, is that central banks are cutting in tandem globally, but we don't have a negative catalyst that's driving it. So for me, it's like central banks are taking out some insurance to help the growth side of their mandate, particularly here in the U.S., and that's very supportive of risk assets.
Do you think this can be explained by some kind of post-pandemic supply-side renaissance that has helped these central banks out and they get to pull back a little bit? Is that what this is?
I think that's part of what it is. Certainly, when I listen to what the Fed has been saying over the last few months, and I think Chair Powell put his marker down very specifically in January, saying that the monetary policy is very tight, but we haven't felt the full effects of it in the U.S. economy because the supply side has been shielding us from that. So it's very rare that we see such dynamism on the supply side, and certainly very rare that we see it globally. But something is happening because goods prices are falling across the board in all major economies. And when I look at producer prices and in major economies, they're either in negative territory on a year-on-year basis, or they're relatively flat like they are in the U.S. So certainly the goods side of the economy and the supply side of the economy is doing a lot of the work for the Fed right now.
Sophia, I want to get into one aspect that maybe got less attention, which was the balance sheet. And a lot of people were looking for the Fed to talk about how they were going to be cooling off on some of the balance sheet roll-off. They still are going to do that, even with stocks at record highs and bonds continuing to rally. Have they really drained liquidity from the system that seems to be just absolutely chock full of liquidity?
Well, I was looking at this last night because, as you know, the Fed balance sheet data come out on Thursday. You're a nerd on the balance sheet, so I know that you know that. Okay. And what's interesting is the Fed's balance sheet was about $4.5 trillion pre-pandemic. We got up to $9 trillion. The Fed has done some QT, but the balance sheet is still very large, and certainly the supply of money seems like it's much higher than what one would have expected to be supplied by the Fed in sort of a normal environment. So we're still dealing with a lot of liquidity. And I think with regard to QT, the Fed is being very smart about it. They've learned some lessons from 2019, where they continued at a relatively aggressive clip. And eventually this led to some frictions in the money markets and prompted them to very abruptly end QT and start QE. So what they're doing here, I think, is slowing the pace, means they can go for longer, and it probably means that QT is less volatile for financing markets.
So basically, you put this all together. The Fed is being very cautious. They want to support the economic cycle. You have fiscal spending that keeps pouring in to support some of the technological advances. Just as you advise investment professionals at your own firm, what's to say this is not early cycle and can keep going for a long time, and that the rally, even if it's getting to higher levels, has legs?
Yes, of course. Again, going back to what I said earlier, I've never seen a cycle where global central banks are cutting in tandem and there isn't a negative growth shock. So it is a very positive tailwind, I think, for growth expectations. When I think about it in terms of the global economy, it seems to me that the way that central banks are acting in unison is reducing the risks to the global economy. It should be raising people's expectations for global growth. And we should start to see these pockets that are more tied to the global beta, the global cyclical cycle, start to percolate a bit more. And I think that's why you're seeing that Japan is still a very heavily subscribed trade. Europe as well. Italy is one of the best performing stock markets year to date. I think that would surprise a lot of people.
Not this guy.
Not this guy. He's into Ferraris and banks, I guess. That's what the MIB has. But in general, I think that it is a very positive global growth environment. So in that sort of context, it's not surprising. People have got cash on the sidelines. Every Thursday, I look at the money market assets, and they don't decline measurably. So there's still a lot of cash on the sidelines. Central banks are taking out some of the downside growth risks, and it looks to be a more positive outlook.
The story. We talked a lot about the story in the last 5, 6, 7, 8 minutes. Can we talk about the price of the story? How relevant is the price of the story? Does that matter at this point, given how strong the storytelling is so far this week, and how justified that is too?
Well, I think it does matter, right? And I think that's one of the reasons investors might be looking for catch-up trades. And again, if central banks are perhaps giving us a little bit more assurance on the growth side, it is giving some investors the opportunity to look for value. So that was one of the initiating catalysts, I think, for Europe and Japan for their equity markets to start to catch up to the U.S. And now we're seeing it in other pockets as well. We're starting to see a bit more interest in small caps and in value. And I was looking at the screens this morning, the Russell 1000, the S&P 1500, those are all moving in tandem with the S&P.
So this Wednesday, we were talking about it, the outperformance of the Russell on Wednesday as Powell was talking in that news conference. As you said, people are itching for catch-up trades. Are there some trades that you advise people against taking, some catch-up trades that maybe you think won't evolve in a desirable direction?
Well, in this kind of environment, I think a lot of things look pretty good, right? There's a lot of positive outlook in terms of growth expectations. Inflation's coming down. And I think this is one of the reasons you're seeing the everything rally. It's, I think, very hard to differentiate. The tide that rises all ships. We're seeing a little bit of that. But, pricing could be an issue for some investors. And again, I think this is one of the reasons people are looking more for catch-up trades. Where can I find good value? Where can I see an opportunity to see a bit more of a catch-up to what's happened in the S&P?
There's been a bit of a debate on the show this morning. Do you go outside of the U.S. or do you stay with the U.S. because a lot of this growth is being driven by U.S. exceptionalism? Peter Oppenheimer of Goldman Sachs saying, go elsewhere. What's your view on that?
Well, I think typically when we get to a Fed cutting cycle, historically, the dollar has trended lower. And I look at the starting point for the U.S. dollar, and it seems quite strong to me. If you look at it on a inflation-adjusted basis, we are at the levels we were in the 2000s. And so currencies do mean revert over time because investors' expectations for growth in other parts of the world will also catch up to the U.S. And as we see that, we could see more capital flows and allocations to other parts of the world. I think also, too, the U.S. still has a current account deficit, about 3%. Not extreme by historical standards, but still something that we need to finance, whereas other economies are in a current account surplus position. And in some cases, they're seeing their surpluses start to expand, like in Japan, in places like Brazil. So I do think that this global environment gets investors to look outside of the U.S. for sure.
Sophia, this was great. Got to do it again. Thanks for being with us.
OK, thank you.
Sophia Drosos there of 0.72. Equities right now on the S&P negative by 0.1%. Let's get you an update on stories elsewhere. Here is your Bloomberg Brief with Yahara Hackers. Hey, Yahara.
Hi, John. Bitcoin is set for one of its worst weeks of the year as ETF demand weakens. The token has pulled back more than 10% after touching all-time highs over $70,000. Bitcoin ETFs are also on track for their biggest weekly outflows since trading began back in January. A net of $742 million have left the funds from this Monday through Wednesday. Reddit rose 48% in its trading debut yesterday, with the social media company closing at more than $50 a share, well above its IPO price of $34. Investor enthusiasm for the listing driven by the company's pitch to profit from the growth of artificial intelligence. Reddit's IPO is the fourth largest on a U.S. exchange this year. At market close, the company had a market valuation of $8 billion. Tesla is reducing electric car production in China amid sluggish sales and intense competition in the world's largest auto market. Sources telling Bloomberg the company instructed employees at its Shanghai factory to lower production of both the Model Y sport utility and Model 3 sedan by working 5 days a week instead of the usual 6.5. That's your Bloomberg Brief. John?
Yahara, thank you. Up next on this program, regulators hitting Apple at its core.
It's a white-knuckle period, no doubt, that Apple's going through. But my view is that after, call it 1 to 2 quarters, they get onto the other side of this with a pent-up upgrade cycle.
You know, I've got the transcript for that piece of sound in front of me, and I was reading it, and I knew it was Dan Ives before I even saw his name. Just white-knuckle ride. It's just sort of like
leather jacket,
Dan Ives-isms.
Rock star.
Yeah, all of that. That conversation is up next. The opening bell, 42 minutes away. Equities pulling back just a little bit. We're down 0.1% on the S&P 500. The bond rally continues. Yields lower by 5 basis points, 421.58 on a US 10-year. Under surveillance this morning, regulators hitting Apple at its core.
It's a white-knuckle period, no doubt, that Apple's going through. But my view is that after, call it 1 to 2 quarters, they get onto the other side of this with a pent-up upgrade cycle. And I believe it's all right now about AI. You do not want to be selling this stock into AI coming to Cupertino. That's why this is, in my opinion, not the time to throw in the white towel.
Well, people are selling this stock. Here's the latest. The DOJ suing Apple for alleged antitrust practices over its iPhone hardware and software. The company also expected to face a probe in Europe as part of another crackdown on big tech. The news putting pressure on the stock, down 11% year to date, underperforming the S&P and the Nasdaq. Joining us now, Bloomberg's Mark Gurman, an Apple guru. Mark, let's get into this. What is the defense coming from Apple in the last 24 hours?
I mean, the defense is essentially that the DOJ lawsuit is littered with nonsense. They make 5 central points, and 3 of the points they make against Apple are things that have either already been resolved or things that Apple said would be resolved. So there's a lot of confusion as to why the DOJ is making allegations against Apple about issues that have already been rectified or in the process of being rectified. The suit is filled with technical inaccuracies related to things that Apple may have done or is doing. And, Apple believes that the DOJ is throwing as many items as it could gather against them, but none of them prove that the company is a monopoly. None of them show that Apple is harming consumers. To me, what you see here is Apple harming some app developers and partners. The major two pieces that seem relevant are the inability to create third-party tap-to-pay payment applications in the US, and the way the company sort of throttles third-party smartwatches when they're paired with the iPhone. So I think this is not going to be a couple quarter type of situation. I think this is going to be a 3-4 year situation where ultimately you see the DOJ adjust their case and maybe narrow in on some specific items. You see a back and forth between Apple and the Department of Justice. What you've seen in Europe in recent quarters, where you've seen the Digital Markets Act and Apple making tweaks to the iPhone operating system to fit those new requirements and make some changes there, I think you're going to see the same thing happen in the US to some extent. I would imagine that Apple is going to pick items one by one and rectify what actually could be changed and sort of try to come to some sort of settlement here, whether this is a fine with the DOJ for past behavior, and then those tweaks to iOS. I think that's going to be able to get this over with, but it's going to take a few years.
This sounds incremental, Mark. This doesn't sound catastrophic. Does this justify some of the sort of existential fear that seemed to come through the market yesterday at a time when everything else was rallying?
I don't agree with the stock sell-off related to existential fear about this DOJ case with Apple. I can make a far better case of why you should sell your Apple stock that has absolutely nothing to do with these DOJ allegations. There are obviously AI features coming soon. Apple has done little to nothing to prove to the consumers and to the marketplace over the last decade plus why anyone should trust that these new AI features will be impressive or on par with what you've seen from competition. I think there are concerns about Apple's next major new hardware category. I think the cancellation of the self-driving car is a massive disappointment and underscores some serious innovation-related problems at the company. So fine, you can sell your stock. I just think you probably sold it for the wrong reasons.
Mark, I'm glad you mentioned AI. The Wall Street Journal is reporting that Apple held preliminary talks with Baidu to put their AI generative technology on devices in China. We have Tim Cook in China right now. Was that part of also potentially the defense when it comes to the US DOJ?
Yeah, I don't think the two have to do with each other. I reported last week that Apple's artificial intelligence plans includes a combination of in-house AI, which is not the more advanced generative AI that you're talking about. And then the other piece of it would be partnering with an outside AI company. They've held talks to license Gemini from Google. They've held talks to license ChatGPT from OpenAI. They've held talks with Anthropic. I reported all of that last week. And for China and for other markets, you probably need a more localized AI player, and that's why you see the conversations with Baidu. It's the same, whereas in the US and many other countries, you have Google as the default search engine, but in China, you have Baidu. And that's because obviously Google is not operational in China. China is a big market for Apple. And if you want the generative AI features to work in China, you're going to need a local partner. And so that's why you see these conversations happen with Baidu.
Mark, I'd love to finish on your latest article in Business Week. You and a couple of colleagues worked on this one. I just want to go to the third paragraph, first couple of lines of it. This year, the Magnificent Seven has looked more like the Magnificent Two, the Middling Two, and the Meth Three. Mark, what's changed this year compared to 2023?
Well, Apple in particular is under a lot of pressure. I would not put the DOJ specifically in that category. I would put regulation as a big category of its own. They have suits in almost every country you can name off the top of your head, with the U.S. being at that top of the list. Obviously, the 27 nations that make up the EU. You have Australia. You have countries in Europe, not within the European Commission. Definitely, this car thing, I think, is a major disappointment. What is the legacy for Tim Cook to hang his hat on in terms of a major new product, when he eventually steps down? I mean, spatial computing, the Vision Pro headset is cool, but does that have the potential to be a $100 billion category like the car could have been? And again, like I said, Apple is the creator of Siri. They've had 10, 15 years who's to say their new AI is going to be great either?
So true. Mark, thank you, sir. You're one of the best. Appreciate it. Mark Gurman there of Bloomberg. Just about got enough time for a final thought, Bramo. What a week.
Everything rally. Just have to say, this idea of mid-2000s, that really sums it up. And we heard that from Bob Michael and then reiterated by Mohamed El-Erian.
But Mohamed El-Erian said, where are we at the peak? If you look at that upside down U, by this banker that had to be bailed out, said to him, we're in the peak, but then came the financial crisis.
Equities right now on the S&P 500 negative here by 0.1%. The opening bell just around the corner. This was Bloomberg Surveillance.